in the aftermath of that disastrous Oval Office meeting with Vladimir Zelensky at the end of the week before last. So for more on this, we turn to our political panel. Rick Davis is with us, Stone Court Capital partner and Republican strategist, alongside Democratic analyst Jeannie Sheehan Zaino, senior democracy fellow at the Center for the Study of the Presidency and Congress. Rick, we can read into his language here, but I do wonder if you're sensing something of a tone shift on the part of the president as this delegation gets ready to go sit down and talk with the Ukrainians tomorrow.
Yeah, absolutely. I mean, it wasn't that long ago where the focus of the Ukrainians were to try and get into the discussion, right? They'd been completely left out of the early stages. Delegation to Saudi Arabia was Russia and the U.S. and nobody else. And so the fact that now the pendulum has swung to the Ukrainians, I think that you would expect to see Donald Trump starting to, sort of shout out more positively to the Ukrainian side, talking about how tough he's going to be on the Russians, talking about lifting some of the bans that he put on assisting the Ukrainians in the war effort, add pressure to the Russians. And so I don't know. I mean, it's so hard to tell, but Steve Witkoff, the president's emissary to these talks, has been saying very positive things. Substantial progress is what he's saying is being made. So we can hope, right? Everybody wants to see an end to the conflict. And I think certainly those of us who support Ukraine want to see Ukraine begin the process of reconstruction and return to some level of normalcy. So we can hold our breath and see what happens this week. But right now we got a negotiation going on, and that's a positive.
Is that how you look at it, Jeannie? The difference between this meeting and the first one in Saudi Arabia is that Ukraine actually has a seat at the table. Is that encouraging you?
Listen, any talking is encouraging, but, the whiplash we've been talking about as it pertains to Donald Trump vis-a-vis the tariffs and the economy, you also see that vis-a-vis his foreign policy and Ukraine. On Friday, he's on social media talking about significant sanctions on Russia to move forward the peace deal. Hours later, he goes to the White House and talks to reporters and says he's finding it very difficult to deal with Ukraine. So I think it is very, very tough to know or to feel confident at this point, looking at this from the outside, that Ukraine is in anything of a better position than it was when Zelensky sat down with Donald Trump in the White House, which is the last time these two sides met. And of course, in the immediate aftermath, intelligence sharing pulled away, right? The idea that Ukraine is going to be in an equal position to negotiate the end of this thing. Donald Trump keeps chastising that they don't have the cards, but they don't have the cards because he's taken many of the cards away from them. So I don't know that I feel that confident in Donald Trump's view vis-a-vis Ukraine. And by the way, all of the headlines coming out so far of the meetings, even though they haven't even really begun, are the U.S. asking things from Ukraine. Where is the ask from Russia? We have yet to hear that.
Well, one of those asks from Ukraine specifically, Rick, is, of course, the sharing of the proceeds from minerals and rare earths that are found in Ukrainian soil. A lot of that, though, is in territory currently occupied by Russia. Is that actually a positive signal to you that the Trump administration may advocate for Ukraine getting that territory back because they want access to what's in it?
That's right. Even Donald Trump knows he can't trust the Russians to give him something that they would have agreed to. So, yeah, I think it's a positive. A lot of those rare earth minerals are in the Russian-occupied parts of Ukraine, and it's a tell that maybe there is a opportunity for Ukraine to regain back some of those, not so much through battle, but through peace negotiations. And I think that's a real card for Vladimir Zelensky. Get him out of there, and I'll make sure you can get your rare earths. And I am encouraged that it looks like the rare earth deal is on track. Even Donald Trump's talking about other things like lithium and other rare commodities that the Ukrainians have in their country, and that there is, in exchange for that, a ceasefire. And I think a ceasefire would really benefit the process, because we obviously have seen the up-tempo of attacks from the Russians since the negotiations started. And I think Donald Trump's got to put his foot down with the Russians and say, look, if you're going to increase your attacks on Ukrainians, then it's going to cost you at the negotiating table.
Steve Witkoff telling Fox News we're going over there with an expectation we're going to make substantial progress. We'll keep posted on what progress they make. Big thanks to our panel, Rick Davis, Jeannie Shanzano, our signature panel with us every day here on Balance of Power. I'm Joe Matthew alongside Kaylee Lyons. Congressman Don Byers on the way in next, the Democrat from Virginia, right here on...
1:40 on Wall Street. We do check markets all day long here at Bloomberg. Developing story at this hour. Elon Musk says there has been a massive cyber attack against X, formerly known as Twitter. Now, Musk's social media platform X says it experienced intermittent outages with users across the globe saying they could not access the service. X experienced a site-wide disruption that also impacted data pipelines that it offers to its users. More than 40,000 users in the U.S. are reporting having issues at the peak of this outage, this according to the monitoring website Down Detector. Right now, we have got U.S. stocks trading very close to session lows, right to the numbers here, with the S&P now down 152 points, down 2.65%. The S&P at 5617. The Dow is down 775, down 1.8%. NASDAQ, the composite index, down 743, down by 4.1%, while the NASDAQ 100 index is down 3.8%. Mag 7 stocks being led lower by the likes of Tesla. Tesla shares right now are plunging 13.8%. We've got the 10-year 4.21%, the 2-year currently yielding 3.91%. Gold down $21 the ounce, down 0.7%. West Texas Intermediate crude trading at $66.10 a barrel, down 1.4%, and Bitcoin down 5.5% right now at 78,534 on Bitcoin. Again, recapping stocks lower, S&P down 153 points, down 2.6%. Keep it locked into Bloomberg Television and Radio for the very latest on the market sell-off. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. And back we go to Balance of Power. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, keeping track of financial markets that clearly are worried about the potential impact of tariffs. Thank you so much. I'm Kaylee Lyons alongside Joe Matthew in Washington, where there is no sign that President Trump is starting to approach tariffs any differently than before, still threatening to put reciprocal tariffs on U.S. trading partners on April 2nd, threatening, of course, tariffs reciprocal specifically on things like Canadian lumber and dairy. Although, didn't he say that that could come, Joe, as soon as a couple days from now, not
correct.
Waiting until April 2nd.
Exactly.
We're trying to keep track of all the different narratives here. What we do know, though, is that leading the trade fight on Canada's part is going to be a different character after yesterday's overwhelming result. Mark Carney, who happens to be the former chair of the board of directors of Bloomberg and better known to our audience as the former head of the Bank of Canada and then the Bank of England, is set to be the next prime minister.
That's right.
And he came out with some fighting words yesterday.
We didn't ask for this fight. We didn't ask for this fight. But Canadians are always ready when someone else drops the gloves. So the Americans, they should make no mistake, in trade as in hockey, Canada will win.
Ironic that it is because of Donald Trump and the tariff policies that we've seen Canada's Liberal Party vaulting into a position that it is now in, very different than where we were even a couple of weeks ago. And we want to talk about it with Brian Platt. He's Bloomberg News Canada government reporter with us live here on Balance of Power. Brian, it's great to see you. Thanks for joining the program today. Is Donald Trump the best thing, actually, that ever happened to the Liberal Party of Canada?
It's completely changed the political environment in Canada. I really think you can't overstate it. And you know, what Americans need to understand is Canadians, I don't think it's an overstatement at this point to say Canadians view themselves as in a state of economic war right now. There's a huge backlash across the country. Canadians are furious, especially about the 51st state talk and the increasingly menacing tone it's taken on. And I would say, if anything, you know, Canada has counter tariffs in place right now. I think, if anything, Canadians want their politicians to go even further in retaliating, and that is the environment that Mark Carney will step into in a few days, most likely as Prime Minister.
Well, so Brian, if this is economic war, how significant is it that the leader of that will be someone who was in some ways a steward of the Canadian economy, leading the Bank of Canada during the financial crisis, then the Bank of England during Brexit? This is not an ordinary politician we're talking about.
Yeah, and you know, like, I was in the room last night when he made that speech. He's not an electrifying speaker, right? He has a finance kind of technocratic way of speaking. even the tone of his voice doesn't tend to change that much when he's giving an applause line. But his experience in steering the UK through Brexit, and he was Bank of Canada governor during the global financial crisis in 2008. This is the kind of expertise that the country seems to be wanting right now, if you look at the public opinion polling. And his sort of like more technocratic and geopolitical expertise style of speaking, I think is really, at least if you look at the polls, that's what Canadians are looking for right now.
All right, Bloomberg's Canada government reporter Brian Platt, thank you so much. And I would note on the late edition of Balance of Power, we'll be talking about not just the ascension of Mark Carney, but also the implementation today of retaliatory 25% hikes on energy exports to the U.S. from the province of Ontario. Ontario's Premier Doug Ford will be joining us at 5 p.m. Eastern Time.
He's not been mincing words and said he would do it with a smile if it meant cutting off energy to the U.S. So that's 5 p.m. Eastern Time. Please join us for Doug Ford. That'll be something to behold.
Indeed it will. But we also have an important conversation here as we close out the early edition of Balance of Power. Joining us in our Washington, D.C. studio is Democratic Congressman Don Beyer of Virginia. Thank you for being here on Bloomberg TV and radio. We have obviously spent a lot of time today talking about tariffs in particular, and that's actually something you are looking for a legislative answer for. You, together with your colleague, Congresswoman Susan DelBene, have reintroduced the Congressional Trade Authority Act, trying to take some of this power away from the executive. Is there any appetite with your Republican colleagues for this legislation to go through?
Kylie, in the short run, no. Right now, all of them are still very cowed by Donald Trump. As his numbers fall, and we think they will because he's doing nothing to help the American people in terms of their costs, which is the reason I believe he got elected. Hopefully some will move over. Certainly if it were a Democratic president, there'd be a lot of appetite to rein in the president's tariff authority. That's not what the Constitution, it gives the power to the members of Congress, not to the president.
You have a real unique view on all of this stuff from your years in the auto business. We hear about these arrangements in which a vehicle crosses the border 7-8 times over the course of its assembly. Is it time to start rethinking that? Why is that going on to begin with, Congressman?
Well, a lot of it, Joe, is they're trying to build parts and where they have the factories, where they have the people with the skill sets. And that's sort of the genius of free trade. I'd love to point out that since 1948 and the liberalization of international trade, it's been the greatest period of growth by far in human history. We've lifted billions and billions of people out of poverty because of trade. And so this notion of recklessly throwing 25% tariffs on our two closest friends and neighbors is crazy.
Well, and we've seen them threatened and then pulled back, threatened and pulled back. But if you're an auto business or any other kind of business for that matter, are you concerned about what it's going to do to investment decisions that businesses are making, hiring decisions businesses are making, even if we don't see the full implementation of these levies for an elongated period of time?
Oh, absolutely. Yes, I was a retail car dealer for 46 years. And the whole notion of they always want investment in new facilities and hiring new people. But if you don't know whether the products can be available or sellable in a year or two, I mean, business depends on predictability, on a certain sense of certainty and optimism about the future. When it's a different every week, it's pretty crazy. What's
going to happen to the used car market if these tariffs are implemented? We all remember what happened during COVID. Used cars were selling more than new cars in some cases. Are we going to see a phenomenon like that because the cost of a new vehicle will be prohibitively high?
I think you're absolutely right, except for Teslas, which will be very cheap to get on the used car market right now. Because everybody I know with the Tesla is trying to sell it.
What do you make of that reaction? You know the power of a brand. I drive down Route 1. I see Bayer Subaru. I see the dealerships that still carry your name, realizing that's not how you make a living any longer. What if you've got Tesla on the board?
Well, one of the reasons car dealers don't like Musk is he was the first one to say he was going to sell directly to the public. And of course, as a car dealer, I think we take the best care of our customers. It's nice to have my name on the building because if somebody doesn't like it, they're going to see me in church or see me at the school or see me at the Safeway and beat me up.
Say, what about that undercoat?
But on a national brand, it's very different. But I do think, Joe, that we will see a real surge in used car prices once new cars become too expensive to buy. We're following what we've done with housing. With all those tariffs on steel, aluminum, and lumber especially, the cost to buy a house is just out of rates for so many people.
Well, if we're considering the cost of things, the cost of purchasing Tesla stock certainly is going down, as you're alluding to. That stock's down some 13% today. The net worth of Elon Musk is going down with it. And on the subject of Elon Musk, obviously Tesla itself has faced some backlash, in part because of the efforts he's making at the Department of Government Efficiency in concert with President Trump. The cuts to federal workers in particular, knowing that your district is literally just across the river in Northern Virginia, what impact is it having at home? And what are you hearing from your constituents about the manner with which these cuts have been implemented?
Kylie, we did a little economic empowerment fair at a local high school Saturday afternoon, had 1,000 people show up. And I stood in line for 5 hours just listening to their heartbreak. And it wasn't just people who'd been on the job for 6 months. Many of them been there 15, 20, 25 years. The biggest story I heard, though, is how many of them that are getting fired are veterans. Some of that's because we have a veterans preference in federal hiring, but also that, and this may be just too conspiratorial, but a number of people with veterans with disabilities were being let go now because if there comes to RIFs later, the RIFs they'll get preference under those RIFs. So they're trying to get them out of the way in the short run.
It's pretty remarkable what the impact that it's having on the local economy here. You're dealing with laid-off federal workers in Northern Virginia. The District of Columbia, based on the budget you may or may not want to sign off on, the continuing resolution, has had its budget canceled. $1 billion in cuts. The D.C. mayor says it's time to start firing teachers and police. Is that going to be signed into law?
It's crazy. Joe, it's amazing that this continuing resolution, which I am going to vote against, actually cuts all cop programs. So it's defunding the police on a national basis. And of course, in Washington, D.C., which I love, it basically takes us back to 2004 in terms of what the budget would be, a revision of 20 years ago. We're going to try to fix it next day or two, but hopefully that won't happen. Yeah.
Well, as you are going to be a no vote on this continuing resolution, your leader, Hakeem Jeffries, has suggested the entire Democratic caucus should be voting no on this legislation, though we saw as recently as last week the guidance from leadership isn't always followed in terms of the conduct during the joint address to Congress President Trump gave. Will that guidance be followed this time, or do you think some of your colleagues, especially those who are in swing districts, might be compelled to actually vote to keep the government open?
It might be, and certainly generally we try to give swing district members the right to do what they think is right, to get them reelected. We want them to come back. I think we'll have almost 100% following Hakeem's guidance this time, mostly because, first of all, it cuts veterans benefits, it cuts medical research, most importantly, you pass a budget where Donald Trump has already said he doesn't have to spend it. This whole impoundment thing, which is unconstitutional, illegal, we're passing a budget that he can just ignore.
Do we shut down, or do we avoid a shutdown here? I realize you don't like it, but even if you vote no, it looks like there might be enough Republicans to say yes.
Maybe. I hate shutdowns. I mean, I'm a Democrat. I believe in good government. But on the other hand, we've got to stop the evil things that Trump and Musk are doing.
So would you want to be in the other chamber right now, a senator who's going to be faced with the decision of either allowing this bill to overcome the filibuster or not? What should they do? What would be the correct decision in your mind?
Well, I'm still very much hoping, unless there are meaningful guardrails to keep Trump from impounding it and keeping the D.C. government going, that we should vote no, in the Democrats in the Senate and hopefully some Republicans in the Senate.
As a local, if you will, to the Washington area member of Congress, give us a sense of what communication you're getting from the White House or DOJ directly when it comes to these cuts, knowing how many federal workers live in your district. Are you reading about it like the rest of us?
I was just reading about everything and talking to the people, hearing their personal stories, 15 minutes to clear out their desk. Yeah, there's no communication whatsoever. I've been in business a long time. This is the exact opposite way that you treat your people.
Fire by voicemail, fire by email.
Exactly, exactly. I long ago figured out, even selling cars, all you're really selling are your people. You can buy the same car a bunch of different places. But you want to have the team that works together. The most important job of leadership is culture. And they're destroying the culture in the federal government right now.
All right, Congressman, thank you so much for being here with us in studio. Lovely to see you, Democratic Congressman Don Beyer of Virginia, here with us on this Monday as the House is preparing as soon as tomorrow to vote on this continuing resolution. Meantime, Joe, on this Monday, it is quite a wild day in financial markets. Just off the session lows right now, but the NASDAQ 100 briefly was looking at a loss of more than 4%, with tech leading what is pretty heavy selling today.
Yeah, it looks like we're back down 4%. NASDAQ Composite, the S&P 500 down almost 3%. Kaylee, also lower is Bitcoin. Have you seen this? We're at 78,000 for a token, and the VIX just keeps cranking. Now up 18% to approach 28 on the VIX. Things are not slowing down. They're accelerating, to your point, and we haven't heard much from the White House to change that yet.
No, of course, we are expecting President Trump just minutes from now will be convening at the White House with a series of tech executives. I would imagine this may be a topic of conversation in addition to tariffs, the CHIPS Act money.
That's right.
Presuming there's a lot on the agenda, and we may very well hear from the president himself if he decides to take questions from the press.
Meet us back here at 5 o'clock. We'll have a lot to review from the Tech Summit, as well our conversation with Doug Ford, as we mentioned, right here on the fastest show in politics with Kaylee Lyons. I'm Joe Matthew. This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody, it is Monday, March 10th, 2025. Carol Massar, Tim Stanovic, live here at Bloomberg headquarters. We are live on TV, radio, YouTube, Bloomberg Originals. Not so sure I'm going to say a very good afternoon because here we go. Once again, saying in 2025, we've got U.S. stocks headed for their worst day this year.
Hey, maybe if you're short this market, it's a good afternoon and a good day to you. But if you are long this market, it is not a pretty. We're going to have more from Charlie in just a minute, but the NASDAQ composite down 4.2% as we speak. The S&P 500 down 2.8%.
Yeah, there's a lot going on. Waning bullish Wall Street views. You've also got a weekend of Trump administration officials and the president also warning that the American economy may be in for a rough patch. So that is certainly front and center for us. So we're going to get into maybe what? Welcome to the new narrative. A U.S. recession. We're going to ask our team about that.
Michael McKee is standing by right here. He's going to answer that question for us. And if that's the case, is American exceptionalism, Carol, a thing of the past?
It's a good question as well on this Monday. Plus, Novo shares are tanking. And then we're going to get into some developments uptown at Columbia University. It has to do with anti-Semitism and the president's executive order. So we're going to get into that over the next 60 minutes.
Plus, Donald Trump Jr.'s big plans to monetize MAGA, all that and more coming up over the next hour right here on Bloomberg Business Week. First up, though, a check of the day's trade and top business stories. Here's Charlie.
Thank you very much. We got you covered on these markets, fast-moving markets to the downside, right to the numbers, because I'm looking at a Dow right now down 815 points. That is a decline of 1.9%. S&P is at 5611, down 158 now, down 2.7%. NASDAQ is down 4.2%, with the NASDAQ Composite Index plunging 766 points. The NASDAQ 100 Index down 3.9%. Big tech being hit hard. Tesla leading the way lower with a plunge now for Tesla of 13.8%. The Dow right now, 4,200 even. 10-year currently yielding 4.22%. The 2-year, 3.91%. Gold down $25 the ounce, 28.84. Drop there of 0.9%. West Texas Intermediate crude down 1.5%. WTI just above $66 a barrel. And Bitcoin, major story as well. Bitcoin plunging 5.7% right now, 78,380 on Bitcoin. Oil, as I mentioned, down 1.5%. Oil slipping as signs of economic weakness in the world's two biggest crude consumers, the U.S. and China. Fan concerns that tariffs will sap global energy demand. But interestingly, we've got a number of major oil companies advancing today. Case in point, ExxonMobil up 2.1%. ADRs of BP up 0.4%. Chevron up by 1%. Again, those equity numbers bear repeating, with the S&P down 158 now, down 2.8%. NASDAQ down 4.2%, and the 10-year 4.22%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So, yeah, we are, no doubt about it, starting with the U.S. stock trade as a chorus of Wall Street strategists is warning about higher stock volatility. You got Morgan Stanley's Mike Wilson saying the latest to sound the alarm on economic growth worries. Other market forecasters include over at J.P. Morgan Chase, RBC Capital Markets, all tempering bullish calls for 2025. You know what's really the catalyst here? You've had Trump's tariffs really stoking fears of slowing economic growth, and you also had the president and the administration making some talks about the U.S. economy. Not such great ones over the weekend.
Well, let's get with it with Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. She joins us here in the studio. Gina, the plunge in the S&P 500's most influential group, big tech. We got the S&P 500 going below its 200-day moving average for the first time since November of 2023. It's off at least, well, more than 8% from its high. The NASDAQ 100 off about 12% from its high. How much is tech weighing on the overall trade?
A lot. I think it's one of three monstrous issues weighing on stocks. It has been the case most of the year. If you look at the Mag 7, for example, they peaked all the way back in December. They're down 16% as of yesterday from their
so
peak.
Almost
and
a bear
more
market.
Weakness. Yeah, pretty significant decline in the Mag 7. Of course, a lot of that is selected stocks, Tesla and NVIDIA weighing heavily there. But nonetheless, that in and of itself is creating a big drag on the index. But it's more than that. Clearly, the Doge firings and the concern about the ultimate consumer outlook as a result of that have been weighing on consumer stocks. At the same time, you do have the tariff chatter, which is creating sort of stalled activity with a lack of a better descriptive term, and a lot of uncertainty. And a lot of that tariff chatter impacts tech as well. I think this is a little bit underappreciated. If you look at the companies in the S&P 500 with their greatest cost of goods sold exposure to overseas economies, it's tech and communication stocks. So those groups being the biggest market cap share also really drove so much of the optimism over the last 2 years, and that's now unwinding.
So it's not a case of just repricing, because we've talked about, right, what a tremendous run-up we've seen over the last couple of years. So at some point, you got to expect some of that to come out of the markets. Is it still just a repricing, or we've gone beyond that?
Yeah, I think up until this weekend, it really was about a reset of expectations that were far too robust. I mean, this is something we started talking about in December. Our fair value models were detecting that inside the market, the S&P 500 was priced for greater than 20% earnings growth to emerge this year, which is a next to impossible task. This just doesn't happen unless you're bouncing out of recession.
Right.
So it seemed almost impossible for the market to satisfy those for the companies to satisfy those expectations embedded in market prices. There was also, though, this underlying narrative, if you will, in the market that the president was inordinately going to pay attention to the market as a guidepost, and he obliterated that theme over the weekend. I think he just crushed it.
You think so?
And that's what's happening today is he just said, we are going to have short-term pain for long-term gain. I don't actually pay that much attention to the equity market. He completely just blasted that whole theme out of the water.
We got clues. Well, I'm trying to think, was it the press event on Friday?
We got clues last week, but he said, I'm not paying attention to it. But then he also said a few minutes later, it's the globalists who are causing this sell-off. So that indicated to me that he was sort of paying attention to it.
Well, the globalists are causing the sell-off because the globalists recognize that tariffs are coming.
Yeah.
Right? Tariffs are coming. And even though he is saying they may or may not come, I'm using these as a negotiating tool, incrementally we have had more and more tariffs implemented so far this year. Maybe not as much as he originally said, but we have had more.
Do you buy it that he's not paying attention to the market? I know you said that idea got obliterated over the weekend, but look what happened during his first term. I mean, there were tweets, there were social media posts. Every time there was a new record. He did the same thing in the Biden administration.
I think we've rewritten history of what happened in his first term. If you look back at 2018, it was one of the most volatile years on record. We had Volmageddon the first part of that year. We had a 20% correction in stocks in the second half of that year. He didn't jump into the equity market to save the day by reversing tariffs in the second half of 2018. There's only so much that he pays attention to the market, but we've rewritten that narrative somehow in our minds. Now, yes, in the first year of Trump's term, we had magnificent returns to equities because he put forward tax reform, which is a net beneficial, has a net beneficial impact to earnings growth. And then we didn't get to tariffs until 2018. It's the reverse today. Tariffs have a net downside to economic and earnings growth that is inescapable. He recognizes this in his commentary. We hope that we might get to some kind of tax reform and some kind of domestic programs to substitute for the loss of earnings momentum from tariffs and some of the geopolitical risks that have emerged as well. But it's a hope, and hope is not a strategy. So the market is saying, okay, real time, things are a lot worse than we were hoping for.
If it is the strategy and it comes to fruition, so tariffs first, then tax cuts later, is that enough to juice the markets and have them come back and provide a floor? Or?
It could be. It could be. It depends upon what kind of tax reform we get. Our best guess is based upon the promises in the campaign, we will get about half as much a benefit as we did in 2017. Just doing the math on the numbers. But it depends on how far earnings expectations have been suppressed with respect to tariffs and what comes out of those negotiations in the second half of this year. It's still very much up in the air.
So it raises the question about valuations, Gina, which Carol was alluding to a little earlier. The idea that people have said by many measures, stocks are expensive right now.
Yeah.
They're out of line with historical standards from a PE perspective. Are we starting to see them come back to earth?
That's a great question. It's something we actually wrote about today for tomorrow, and the answer is no. Unfortunately, the reality of the U.S. equity market is we were so far above our valuation bogeys that even with the 7% or so correction that we've had in stocks so far, we're still near all-time high valuation levels set in the post-pandemic period. That's only for U.S. stocks, though, and it's really specifically for large-cap stocks. I still think that the international opportunity is there, even with the re-rating. This is a year where international stocks are just likely to shine with the programs that are being initiated. And small caps have derated again. Small caps have had an absolute horrible February and early March so far, and they have derated once again to be at discounted levels.
Is there anything, just kind of final question, final thought at this point, anything about the selling that we're seeing that makes you a little bit nervous? I mean, the VIX is 28. It's not like it's up to 40.
Yeah, that actually makes me nervous.
Okay.
The fact that the VIX has, we talked about this a lot on our team call actually this morning, is what's happening here with volatility, because low volatility stocks are absolutely pummeling high volatility stocks right now, but the VIX has only incrementally moved higher. You love a huge spike in the VIX because those are usually affiliated with bottoming formations in the equity market, like we had with the Japanese yen meltdown last summer. We had a VIX spike all the way to near 40. I think it even got above 40 intraday. Very clear sign of panic. We don't have any panic emerging yet. Instead, we just have this sort of seesawing upward direction of volatility. The last pattern like that we saw was 2022, which was obviously a horrible year for stocks.
Right.
That was also the last time we saw such an extreme underperformance by U.S. equities compared to the rest of the world.
That was that when that yen blow up happened, Carol. That was back in August. The S&P 500 was at about 5,200. It's at 5,600 now, so about another 8% to go to get back to there.
Happy Monday, everybody.
Good news all around.
Gina, thanks so much. Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist for us here. All right, so now we need to really talk a little bit more about the U.S. economic backdrop that's fueling today's risk-off trade almost.
Hey, Gina said it. Anxiety that tariffs and government firings will torpedo growth in the world's largest economy, extending this 3-week stretch of volatility across global markets. As you just heard, American stocks fell as Wall Street forecasters tempered their bullish views, while demand for recession havens boosted sovereign bonds in the U.S. and Europe.
And when it comes to a recession in the U.S., President Trump added to the concerns about an economic slowdown when he appeared on Fox News yesterday and was asked whether he is expecting a recession this year.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
That is President Trump appearing on Fox News yesterday. Now let's get to the latest on the U.S. economy and the prospect for a U.S. recession. Back with us is Bloomberg News international economics and policy correspondent Michael McKee here in studio. So are investors making a big leap from transition, which we heard the president use the term, to recession?
I'll start by saying Gina was the little black cloud over the markets today. It's an interesting question because the economic fundamentals have slowed, but they haven't given any sign that they're falling off a cliff. And while the equity markets are jumping out on the window ledges on Wall Street, the bond market is not. Yields have come down some, but if you look at both high yield and investment grade spreads, they're still very, very tight. So it's hard to say that a recession is baking itself into the cake. The New York Fed has a recession indicator that suggests that we're getting pretty close to recession, but we've also gotten false signals from that over the last couple of months. And last Friday, Mickey Bowman of the Fed was noting that it's possible that the whole idea of yield curve inversion isn't working anymore for some reason. And we saw that with the yield curve inverted for 2.5 years and no recession. So it's hard to say that we're actually going to have a recession.
If somebody from the Trump administration were here, perhaps they'd say what Kevin Hassett of the National Economic Council said on CNBC earlier today. The second quarter will, quote, take off after tax cuts.
The second quarter is not going to take off after tax cuts because tax cuts aren't going to happen until the third or fourth quarter. And that's another thing.
But the market can kind of lead right?
Yeah.
Expectations of something.
Everybody's talking about tax cuts. The basic part of the whole tax exercise this year is just to extend what we already have. And if they do that, which is got to be your base case scenario because it's hard to finance the rest of it. If they do that, your paycheck's not going to change. I mean, it's not going to go up, which would be a tough thing for the economy, but it's not going to go down. You're not going to suddenly have all kinds of extra money to spend. So it's a little bit of a misleading debate. Now, if we stop taxing tips, that'll help a little bit on the margin, but tips basically are the lowest paid workers in America. And so they're not going to be adding that much to GDP. And seniors, if you don't tax Social Security, seniors don't spend as much. They're on fixed incomes. So it's hard to see tax reform other than a psychological tailwind to the markets really adding a lot.
How quickly can the U.S. economy go from okay to or signs of weakness to a recession?
Very quickly, and that's part of the problem that we have is nobody can really call a recession.
Yeah.
The old joke about
we're those guys who are like, hey,
the markets.
I believe they're referred to as eggheads.
That'd be us. The markets have called like 7 of the last 3 recessions, I think, is the old joke. Because it's a confidence thing. It's when people lose confidence, and that's what's really hard to measure. We did get the consumer confidence numbers, and we'll get Michigan on Friday. And we did get a New York consumer confidence reading today that suggested that people are growing more concerned about their jobs and income prospects. But it's really a kind of a fast collapse that leads you into recession. And right now, that could happen. I'll go back to 2001 when George W. Bush took over. That was when we were just having the tech bubble burst. And he was immediately talking about, well, maybe we need to do some stimulus here to keep the economy from going into recession. And the question then was, could he be talking the economy into recession? And that may be where we are now, in that we're all talking about it, and then Americans out there who are listening to this program are saying, oh no, let's head for the bomb shelter.
Well, as Tim reminded me, and I was like, what? There's a Fed meeting next week, and we get a Fed decision. How does Jay Powell and the FOMC and the voting members take some of this market volatility, this Trump conversations and qualification of the economy, maybe this transition, do they take that into account? And could we see some kind of rate move next week?
No rate move next week. They've Jay Powell just spoke on Friday and said no rate move next week. They don't have enough evidence of anything, and by the time they meet next week, who knows what the stock market will be doing? It could be up 120, or 300 points or something. So they will take it into account as part of their overall "we're watching things" mode, but it doesn't really figure in.
Mike, I want you to get the weigh in on whether or not Trump looks at the market today like he did in his first administration, his first term, something Gina was talking about. Is there something to be said with the idea that because of the populism that he has embraced, that his administration has embraced, if the stock market goes down, it's not necessarily a big deal because of who owns the majority of the stocks in the U.S.?
Well, that's a bit of a misnomer. Now, I can't read Donald Trump's mind. I don't think anybody, even him, can read his own mind. So we don't know what he's going to do day to day. There was the idea coming into this administration that there would be a Trump put, which he has so far not exercised and has suggested he'll let things go. But does he really want the market to crash? You got to remember that a lot more people own stocks than we think. I mean, sure, the very wealthy own a lot of stocks, and he is doing a lot to protect the very wealthy these days. But through their 401ks and pension plans and things like that, that also the markets affect the average person. So it's kind of hard to know exactly what his position is on this. And as people say, it's hard to know whether he's playing 4D chess or not. And we all just got to watch.
All right, we got to run. Mike McKee, thank you so much. Hey, coming up next, we talk about European exceptionalism. That's next.
It's 2:21 on Wall Street. We do check markets all day long. Here at Bloomberg, we have got the NASDAQ 100 index set for its worst day since October of 2022. Right now, we have got the Dow, the S&P, NASDAQ 100 index, and the Russell 2000 index all very much in the red. Keep it locked into Bloomberg Radio and Television for the latest on these declining markets. The S&P right now down 158 at 5612. That is a decline of 2.7%. Anxiety over tariffs and government firings sending stocks lower, with the Dow now down by 872 points, a decline of 2%. NASDAQ down 765 for the NASDAQ Composite Index, down 4.2%. The NASDAQ 100 index now down by 3.9%. 10-year 4.23%, with a 2-year currently yielding 3.91%. Gold is down 0.9%, $28.83 the ounce. West Texas Intermediate crude holding just above $66 a barrel now, down 1.5%. And Bitcoin, we are seeing a major sell-off there, down 5.6%. Bitcoin at 78,454. Right now, Apple shares are moving lower. Apple down 5.4%. It is seeing its biggest intraday drop in more than a month. Tesla leading tech stocks lower. Tesla right now down by 13.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Well, you just mentioned the big numbers here, worth repeating because it is such a day, if you are long this market, not so good. A lot of red. The S&P 500 down 2.8%. The NASDAQ Composite down 4.2%. For more on the markets, Bloomberg News senior editor Mike Regan joins us here in the studio. Mike, the reaction that we're seeing today, part of the unwind that we saw last week?
Yeah, I think so. I think, Tim, some of the comments that President Trump made over the weekend obviously have people sort of recalibrating their expectations for how Trump might react to this stock market swoon. I mean, clearly, look, we're down more than 8% in the S&P from its last high, almost 13% in the NASDAQ 100. I think, anyone who was around during Trump's first term sort of got in the habit of thinking that, well, if the stock market reacts too poorly to some of these policies, that maybe he'll soften his tone on them a little bit or backtrack a little bit. It seems like in this instance, at least in these early innings of his second term, that's not the case. He made remarks on Fox over the weekend saying, the economy's in for a period of transitioning, and that, he's not necessarily looking at the stock market and allowing that to worry him about these tariff and government job cut plans that he has. So, I think all of Wall Street today is waking up to the idea that the administration, and it sort of echoes, the Treasury Secretary Scott Bessent had said similar about the economy needing to go through what he called a period of detox. So, I think investors everywhere are warming up to this idea that this administration will tolerate not only some stock market weakness, but some economic weakness in order to achieve their longer-term goals, rebalancing trade and shrinking the government.
To be fair, Mike, I mean, we're still up, I think, 46% on the S&P 500 over the past 2 years, since the end of 2022.
Yeah, it was 2 strong years. Yeah.
Right, 2 strong years. And we've said that at some point there needs to be a little bit of a repricing considering the run-up here. Having said that, if this is the environment where tariffs persist and more tariffs come, even if we get tax cuts, I mean, does the sentiment still stay kind of risk off here?
I don't see it coming roaring back to risk on in the near term, unless we hear some kind of decisive change of tack. The one thing about President Trump, obviously, is he changes his mind a lot, or at least he changes his messaging and his decisions on tariffs. So at some point, this nasty of a market, one would think, could still maybe cause him to change his mind and maybe push back those reciprocal tariffs or the April 2nd tariffs a little bit further. But he's very unpredictable, as we all know. So it's hard to really say X and Y need to happen in order for Trump to do Z. I think we all just have to wait on the edge of our seats and see how he reacts to this.
I will point out 325 names to the downside in the S&P, but 176 to the upside. So it's not like investors have run away from everything.
Yeah, a lot of the defensive, sort of economically defensive sectors are doing okay today. And the real high flyers, those NASDAQ NASDAQ 100, the Mag 7, those are really, at times like this, it's those highly valued companies that tend to take it the worst.
Tesla down 14% as we speak.
Yeah, I mean, there's a lot of questions there, right? We keep covering it and some of the concerns in some of its key markets. Mike, thank you so much. Bloomberg News Senior Editor Mike Regan. We're going to stay with the markets, but also broaden out and get a C-suite view. I mean, we've talked so much this year often about how European markets are outperforming the U.S. market by a wide margin. The Euro Stoxx 50 is up about 10% year to date, while the S&P is now down, I think, close to 5% in 2025.
With a view on that contrast and the continued electrification of our world, let's head on over to London and to Gwenaëlle Hewitt, Executive Vice President of Europe Operations over at Schneider Electric. It's based in France. Schneider manufactures electrical power products. The company's ADRs trade in the U.S. This year down roughly about 5%. Gwenaëlle, welcome. First up, the global market environment today, geopolitics. How difficult is it to do business in this economy, in this market?
Well, I think that what we are looking for is some strong position in Europe in order to shape what will be the future of the industry in Europe. And in that sense, it can be as an electroshock, right? To switch gears. I mean, for the past years, the European Union has been regulating quite a bit. Now we need to project that into concrete investments, into a very friendly environment for industry. And that's what we're expecting right now, right?
You are expecting a friendly environment for industry?
Exactly. I mean, the European Commission just announced a week ago a clean industrial deal in order to promote and accelerate the development of the industry in Europe. That's what we need. We need a European industry that is much stronger. We need to build and to boost its manufacturing footprint within Europe. We need to compete globally. And the European Commission has a role to play in that sense. Of course, we have a very strong assets. The first one is being a very large internal market, but at the same time, we have very strong industrial players. So we need to leverage on that. And the problem is that in the past years, there were a lot of regulation, sometimes over-regulation. And now we need to come around more incentives, how to accelerate through more incentives, friendly environment instead of only compliance and just regulating in a very difficult way.
Gwenaëlle, I do want to ask you, though, about the U.S. market versus the rest of the world. I mean, how do you describe the demand that you're seeing from your U.S. customers? And from what I understand, you guys produce about 83% of what you sell in North America locally. But tell us about North American demand, U.S. demand specifically, and then what you are seeing in terms of demand outside the United States. Is it strong in both areas? How would you describe it for each?
Well, so just to put it simple, our model for Schneider Electric is a very much local model. So what we sell in the US is produced in the US, what we sell in Europe is produced in Europe, et cetera, et cetera. That's really very much important, especially in geopolitical context that you're seeing today. The mega trends that are below that, that are below the business, is around energy transition. It's around data centers and electrification, digitalization, and all that remains across the world. So I can tell you today that yes, we have huge demand in the US and we are building factories, expanding, etc. But Europe is also an area of growth. Why? Because we had in the past years the EU Green Deal, favoring renewable energy development, favoring also energy efficiency, and this is taking off. So when you look at our numbers, yes, we created growth also in Europe. So that's why, we have to remain hopeful because the sustainability asset that we have built across Europe is still valid.
What about in the U.S. when it comes to the switch to renewables? Because we've heard from the president that he does not favor the policies of the last administration. He likes to call the Green New Deal the Green New Scam. And he talks about drilling here in the U.S., not the switch to renewables. How does that affect your business?
But let me come back to Europe, because at the end of the day, this is an asset that we have built in Europe. So how to continue differentiated by developing the own technology in Europe. And there is a lot to be done. Look at electrification. Electrification in Europe is stagnant. So we need to accelerate. I don't want to give the impression that everything is done in Europe. On the contrary, we have to fight for more electrification because, again, this is a challenge, more digitalization, more renewable, and hence more investment into the network. This is not a done deal. So that's why when it comes to Europe, you have big numbers, big targets in terms of decarbonization, in terms of renewable energy, in terms of energy efficiency. We need to turn that into reality already in Europe.
But in the U.S., if you don't see those policies coming from the federal government, do you start to see companies moving away from that, and that affects your business?
Well, again, I told you, we are very much across the world, and in US, we are very much local for local. We have our own customers. We have a huge trend over there. And the mega trends that I was discussing about around digitalization, electrification is still happening. So let's not oppose one to each other. I think that we have to look at each and every market, and within these mega trends, which one can accelerate faster depending on the context that we foster. And in Europe, again, it's not a done deal. So that's why it's not against Europe, against the US. On the contrary, each and every region has their own pathway. The question is that now with the geopolitics, everybody is, looking around. I think that we need to focus on the own market, and being the most local company is really an asset.
So it sounds like, and forgive us, I think we're just, came in Monday and we saw a global sell-off, and I think we're trying to you have a great vantage point in terms of looking around the world and in terms of business and really trying to understand. I mean, you guys sell big time. North America is your biggest market. Asia Pacific is just right behind it. Western Europe, of course, as you've been saying, very, very important. And then, you've got almost $5 billion in the rest of the world. So you really have this great snapshot of what is going on globally. And I think we're trying to assess, as we watch the US market come down, we saw European markets also under pressure, that are we starting to see some kind of global slowdown? It sounds like from what you are saying that you're not worried about it, whether it's a US recession or global recession. That's not necessarily something that's in the cards from what you are seeing. Is that fair?
You know what? Why I'm so optimistic is that I'm looking at the mega trends that we at Schneider are positioned. Okay, it's climate change, it's energy transition, it's electrification, it's digitalization. Those mega trends are not slowing down, so that's why we are still optimistic. And to give you one example, you're saying it's challenged in Europe. Today, there is a discrepancy between commitments that leaders have been taken and the reality of the projects that are developing. So we need to accelerate. So that's why I really want to continue pushing and showcasing that even in a country or in a region that is so committed to the energy transition, we need to continue having attention. I give you one number. Just, to fulfill the commitment that we have in Europe for renewable energy, we should develop 30 gigawatts of wind a year. And now we are developing only 17 gigawatts. So just to showcase you that in reality, the path, the acceleration should be made also in Europe.
Good stuff, and some perspective on a day where it's very easy to get distracted, probably rightfully so by the markets and concerns about the outlook, but certainly some optimism from Gwenelle Hewitt. She's Executive Vice President of Europe Operations at Schneider Electric, joining us from London on this Monday. Quick check on the markets.
Yeah, NASDAQ Composite down more than 4% right now. The S&P 500 down 2.8%. And just because I like talking about crypto, CRYP Go on the Bloomberg Terminal, Bitcoin down 5.8%, Ethereum down 7%.
Still ahead on Business Week, Novo's new obesity drug disappointing again. What you need to know about it when we come back on Business Week.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. NASDAQ 100 index set for its worst day since October of 2022. Back to work Monday, and we are looking at a major sell-off for the U.S. equity market. Got to keep it locked into Bloomberg Television and Radio for the latest and see how things shake out at the close and how Asian markets react tonight. Right now, we've got the S&P down 170. That is a decline now of 3%. The S&P at 55.99. The Dow is down 951 points for the Dow Industrials, a drop now of 2.2%. NASDAQ is down 780 points for the NASDAQ Composite Index, a drop there of 4.3%. Speculation is growing that President Trump is willing to tolerate economic hardship to achieve long-term goals. The 10-year, 4.21%. The 2-year, 3.90%. Gold down $22 the ounce, 28.87, down 0.8%. West Texas Intermediate crude oil down 1.6% now, 65.97 a barrel. And Bitcoin now down 5.7%. Bitcoin at 78,329 on Bitcoin. Corporate news: Rocket is pushing deeper into the property market with a deal to buy Redfin that values the real estate listing site at $1.75 billion. Rocket, though, down 15.9%. Redfin, meanwhile, is surging by 67.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Folks, we have been keeping a watch on shares of Novo Nordisk because they have plunged the most since December after another disappointment for the drug maker's next generation and new obesity drug, CagriSema. I'm not sure I'm saying it correctly, so we're going to ask what our Madison Mueller has to say about that because I'm not sure I have it right. The stock, though, has been, the ADR is down as much as 10% today. So let's get to what you need to know about this and really the overall GLP-1 trade and narrative. Back with us is Bloomberg News health reporter Madison Mueller. She's in Miami. She's at the Leerink Partners Global Healthcare Conference. Hello. Have I said it correctly?
Hello.
Is that the name of the
CagriSema. You were close.
Okay, close.
You were close.
Is everybody talking about this at this conference? I have no idea what this conference is about, but just curious.
It is actually surprisingly no, at least not from what I've heard. I mean, you would think that they were, but I think that the focus mostly has been on President Donald Trump and the new administration. There's a lot of panels and sessions on that. So I think that that's actually been a big focus for this conference to start off, at least.
Well, let's go there. If that's the big focus of the conference, what have been the takeaways? Because you also have another really interesting story about Robert F. Kennedy Jr., who heads up HHS. And potentially what some senators are demanding. It's interesting, and we'll get to that. It's interesting, though, because is there an opportunity, do these investors see an opportunity within an administration that has somebody at the helm of HHS who has argued against Big Pharma?
Yeah. So that's the thing that these senators, there's three Democratic senators, Senator Warren, Wyden, and Sanders. They're demanding, they wrote a letter this morning to RFK demanding more information about the meetings that he had with Trump and with some big pharma executives, which is something that we've reported on. And there really hasn't been a lot of details that have come out of those meetings and that have been shared publicly, at least. And one of the things that RFK Jr. has called for is radical transparency. And he's also spoken out, like you said, against big pharma companies. So I think that these senators are really wondering what's happened in this meeting, what are drug makers lobbying for, what are they pushing for, and if RFK is really all about radical transparency, then, he shouldn't have a problem sharing it, at least that's what they've said. And so that is a question, though, of what's going to happen with weight loss drugs and with other pharmaceutical products with RFK at the helm of HHS. So far, it seems like it's kind of a big question mark still. But we have seen already RFK sort of go back on some of his promises, at least that he made in the confirmation hearings when he said that he wouldn't mess with the CDC's advisory committee for vaccines. Some of those meetings have already been postponed or canceled. And so we're already seeing some changes, at least from his public narrative. And so I think that it still remains a question, and a lot of executives are wondering, like, how do we navigate this and what's going to happen next?
So it sounds like, Madison, they're a little bit on the fence here in terms of executives, like not quite sure, is it going to be, I think there was a thinking it'll be an easier regulatory environment and maybe easier to get, right? So, but it sounds like, are they on the fence just kind of waiting to see?
Yeah, it sounds like they're waiting to see. I mean, at least that's what they're saying publicly. At first, like you said, there was a lot of optimism and, about an easier regulatory environment, and just that, Donald Trump's administration would be more business friendly. But I think that initial optimism, at least, is sort of being walked back a little bit. That being said, companies are still publicly really trying to curry favor with Donald Trump. We saw Eli Lilly a couple weeks ago announce a $27 billion manufacturing expansion in the U.S. specifically, sort of, answering Trump's call to bring back domestic manufacturing. So we are at least publicly seeing companies still trying to curry favor with Trump.
Is there any discussion about funding of universities and funding of biotech research at universities here in the United States? We've spoken to some folks on our program in the last couple of weeks who did mention that a lot of interesting developments have tended to come from research that's been done thanks to federal grants. Is there any discussion about that happening at this, Madison?
Yeah. Not that I've heard so far, but that is something, again, that I think is sort of brewing under the surface. And I was talking to a couple of people in the last few weeks who were saying that for biotech companies and for big pharma companies to really speak out publicly about the changes that are happening from the new administration, whether that's funding cuts or meeting cancellations or whatever it is, that there's sort of a line that the new administration will need to cross, and we maybe haven't crossed that line yet. These people were saying that might happen when there's layoffs or funding cuts that happen at the FDA Center for Drug Review. So the ones that are really overseeing the process of bringing new drugs to market, which obviously is extremely important for pharmaceutical companies, biotech companies. They were saying that might kind of be the line, but that there is probably sort of a line that these companies have that they'll start speaking publicly when the new administration crosses that, if they do cross that.
All right. I have to go to Novo because investors definitely drawing a line in the sand today. Shares of the ADRs of Novo Nordisk that trade here in the U.S. are down more than 9% right now. What do we need to know about this news today, about this kind of next new diet drug from them?
Yeah. So we talked about CagriSema back in December when Novo released results from their obesity trial. And that's when investors were initially very disappointed. They had been expecting 25% weight loss from this next generation drug, and it did not hit that. And this trial is sort of a follow-up to that. It was in patients with type 2 diabetes. So in patients with type 2 diabetes, usually there is less weight loss anyway. Investors were still expecting like 20% weight loss, which is actually what the obesity trial came in at in December. And so I think that the results to me are not extremely surprising, but it is sort of, we've had so much positive sentiment about Novo over the last couple of years that any sort of disappointing results now I think are really, grab attention and people are really paying attention to and maybe overreacting to a little bit. But this result wasn't totally out of left field based on the obesity results. But I think it's just the expectations for Novo have been so high that it's hard when they don't meet those.
Yeah, let's remind everybody in 2023, it was up more than, the ADRs at least up more than 50%. A little bit of a pullback yet last year, but they've been on a tear.
Hey, Madison, just 30 seconds. How much improvement are these companies looking for with the next gen of obesity drugs?
Yeah, so the 25% threshold is really the threshold for next generation products.
Okay.
That's what they're looking for. Eli Lilly's drug Zepbound is like around 21%. So it's really, the next generation products have to beat that because it's a really good drug. Side effects are not as bad as Ozempic and Wegovy. And so you want less side effects, more weight loss, around 25%. Or if you can come up with an oral drug that works as well as the shots, then that's, the next big thing as well.
Yeah, that feels like a holy grail. Hey, I highly recommend, you have a great story on the Bloomberg, a quick take, why the obesity drug revolution is a work in progress, to remind us that there's going to be kind of these, feels like start and stops as we go along. Great stuff. We know you're busy. Thank you so much for checking in with us. Madison Muller, of course, Bloomberg News healthcare reporter. Do check out her reporting. She's got a bunch of stories out there, including how senators want more info with about that meeting by RFK, which we talked a little bit about, but there's more on the Bloomberg as well.
A quick update on the markets. The S&P 500 down 3%. The NASDAQ down 4.3%. NVIDIA down 5%.
All right, coming up, everybody. U.S. college campuses increasingly the latest focal point for the Trump administration. That's next on Business Week.
This is Bloomberg Business Week with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, let's get to another development on our radar. A Palestinian student activist at Columbia University who led anti-Israel protests last spring was detained by immigration authorities at his home. The Associated Press reported that Immigration and Customs Enforcement, or ICE, officials entered the university-owned building in Manhattan, Upper Manhattan, on Saturday and took him into custody. This is according to his attorney, Amy Greer. So with more on what we know, Bloomberg News New York Bureau Chief Katya Porzakansky is here with us. Katya, what do we know about this?
Yeah, so we know that he is, his name is Mahmoud Khalil. He was the spokesman, one of the many spokespeople for the Quad group, which is this coalition of different student groups at Columbia University. Obviously, they were kind of like the epicenter of protests over the spring, and he was one of the people that were more out there. He was on a student visa at the time, but now seems to be he got his permanent residency, his green card last year, according to court documents, and he's married to a U.S. citizen. So it seems that the Trump administration has, or the ICE has detained him. They've moved him to a facility in Louisiana, and they're citing, support of terroristic activities. Now, the thing that's kind of interesting is that he will, he should be getting due process. So. There are already court filings explaining the situation. They say that this is a repression of free speech and activist activities. But there are grounds under which a person with a green card can lose their residency, both through terrorist activities or support of terrorist activities, including just endorsing or espousing views. As well as foreign policy threats that is a little bit more wishy-washy.
Well, the president out on social media just a couple hours ago saying this is the first arrest of many to come. We know there are more students at Columbia and other universities across the country who have engaged in pro-terrorist, anti-Semitic, anti-American activity, and the Trump administration will not tolerate it. Many are not students, they are paid agitators. Now, we don't know about whether or not they're students versus paid agitators or they're outside versus inside universities. What's the message that the president is sending to universities right now?
This message has been really ramping up, first of all, in the last few weeks, but it's a message to the universities, I think, to take some of the accusations of anti-Semitism on their campus much more seriously. However, of course, the anxiety that a lot of free speech people have is that this doesn't stop there. First of all, that itself could be a repression of free speech, but also that it doesn't end there, right? At least with regard to Columbia, this is the school where they've really started targeting and taking action. Just last week, they canceled $400 million worth of funding and grants to Columbia, citing allegations of anti-Semitism or the failure to respond to allegations of anti-Semitism on their campus. And remember, when you get funding from the government, as most universities do, and they get billions of dollars worth of funding, Columbia gets $5 billion worth of funding from the federal government. You have to abide through certain rules, such as Title VI, which means that you can't be violating or encouraging, or not encouraging, but failing to act to the violation of civil rights of other students on your campus. So that's what they're going after the funding through, at least. And then this is an extra step or a separate step looking to clamp down on the other types of activities.
I think there's a million questions out there, and I guess we're all waiting. What is next? What are we expecting? What is the due process for him?
So I'm still learning this, but I've been talking to some immigration attorneys today. As a permanent resident of the United States, he is supposed to be entitled to due process and be able to fight his case in front of an immigration attorney. Now, he was moved from this detention center locally to one in Louisiana, and the speculation is that he could find a less sympathetic judge over there in Louisiana than what he would find here. However, there's also this question of what is in the charging document, which we don't have a copy of just yet, because that will tell us a lot as to what avenue the government is going to pursue in terms of sending him out. And apparently, there are ones that are a little bit more strict that would tie a judge's hands a little bit more.
Are we thinking that this is something like this could go to the Supreme Court?
I'm not sure. In fact, an attorney that I spoke to said the fact that you've had the State Department, the Department of Homeland Security, and now the president all speaking out publicly about this individual, saying that this individual has to go, it's actually probably going to be less, give a judge less of a reason to try to hear him out.
Another interesting development on a day that there's a lot going on. Katya, so glad we could get some time with you. Katya Perzikansky, she's New York bureau chief here at Bloomberg News, joining us here in studio. We got to talk a little bit more about the markets before we wrap up.
Yeah, we're seeing red across the screen. A quick headline, though, a redhead crossing the Bloomberg. Tesla extending its slump to 15%. It's the biggest drop in a single day, going all the way back to September of 2020.
Yeah, we've seen this one pull back rather dramatically. I'm just pulling up some numbers here on the Bloomberg. It's down 53% since mid-December of 2024 last year. So we are seeing quite a pullback in that on a day where we're seeing really a pullback in many different sectors, except for some of those defensive names, down 3.25% on the S&P 500. The NASDAQ 100 down 4.33%. For those watching on TV, the close coming your way. Tim and I continue on Business Week.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. The markets continue to have anxiety over tariffs, inflation, federal layoffs, and President Trump's dismissal of their concerns. The Dow is down 1,000 points. CBS business reporter Jason Brooks.
Investor concerns over tariffs and the economy have whittled away the stock market over the past week, and the selling in tech stocks is accelerating after the NASDAQ last week sank into correction territory, down more than 10% from its record high in December.
China's retaliatory tariffs went into effect today, and they'll likely hit American farmers hard. Correspondent Anna Corin is in Beijing.
The tariffs include 15% on U.S. chicken, wheat and corn, and 10% on products like soybeans, pork, beef and fruit. Well, this is in response to the now 20% blanket tariffs President Trump placed on all Chinese goods.
And in Canada, Ontario's premier has announced it is now charging 25% more for electricity shipped to the U.S. That could impact more than 1 million Americans in 3 states. The Justice Department is looking into why we're paying so much for eggs. Scott McFarlane reports a watchdog group called for the investigation.
To review why egg prices are so high, whether it has to do with that bird flu or if there are other potentially more pernicious causes that are raising the prices of eggs.
Republicans have another budget plan, but Caitlin Huey-Burns reports despite President Trump's endorsement, it has opposition from Democrats and at least one major Republican.
Already today, we have Thomas Massey, congressman from Kentucky. You've probably heard his name a lot during these funding fights. He came out today and said he's absolutely against it. It would take a lobotomy, he said, to support this. So already down 1 vote.
A government shutdown could come on Friday. Secretary of State Marco Rubio is in Saudi Arabia for talks on Ukraine, and he said today they could lead to the administration releasing assistance to Ukraine. CBS's Holly Williams reports the president has indicated as much.
Trump said that the pause on intelligence sharing had just about been lifted, but didn't give any further details about what he meant by that. Meanwhile, diplomatic wheels are turning. Ahead of that meeting in Saudi Arabia tomorrow, a senior U.S. official says that Ukraine wants to move forward.
Ukrainian President Zelensky is in Saudi Arabia but will not be part of the talks. The leader of student protests at Columbia University is facing deportation after being arrested by immigration officials. Mahmoud Khalil was arrested Saturday. His lawyer says agents claim they were revoking his green card. President Trump says it's the first arrest of many to come. This is CBS News. Labor unrest has caused travel disruptions in Germany. CBS News correspondent Steve Kathan reports delays in Germany can back up flights worldwide.
A one-day strike by workers hitting 13 airports in Germany. Canceling most flights. It involves public sector employees at the airports as well as ground and security staff. Pay is the major issue. It's estimated more than 3,500 flights are affected, more than 500,000 passengers. Steve Kathan, CBS News.
A single-engine plane with 5 people on board crashed and burst into flames in the parking lot of a retirement facility near the airport in Lancaster, Pennsylvania. All 5 people survived. Mannheim Township Police say it may not have been a miracle, but they say it was close. Recapping Wall Street, the Dow is off 1,121 points. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio.
And a very good afternoon, everyone. We are just about 55 minutes away from the closing bell on Sell-Off Monday. I think you can kind of say it.
Yeah, I think we can call it that. Is that fair to say? I saw a 3 at the front of the S&P 500 on the downside, Carol. 3.3%.
To the downside.
Wow.
Almost 200 points lower on the S&P 500. We're pretty much at our lows of the session. Same thing for the Dow Jones Industrial Average, more than 1,000 points to the downside.
She did it. She cited points.
Just for you.
It's a big day. That means it's quadruple digits.
It is 2.5% to the downside. NASDAQ 100. So we're looking at those big tech names really getting hammered. The Magnificent Seven. We have seen all of those names selling off today. NASDAQ 100 right now down 916 points. That's good for a decline of about 4.5%.
Hey, I'm looking at shares of Apple down 5.8%. A redhead crossing the Bloomberg terminal. Mark Gurman out with a scoop. Apple preparing one of the most dramatic software overhauls in the company's history. It's aiming to transform the interface of the iPhone, the iPad, and the Mac for a new generation of users. That revamp due later this year is going to fundamentally change the look of the OS and make Apple's software platforms more consistent. This is according to people familiar with the matter.
So keeping an eye on Apple. We mentioned the overall equity trade, the bond market, though. What exactly is it telling us? Our Mike McKee referencing it a little bit earlier. Are we headed toward a recession? Michael McKenzie on the recession play. We'll get into that in just a moment.
Hey, also, what's going on with real estate in this market right now? We're going to check in with the COO of the Dawson Company. They've got projects happening in multiple states right now.
And speaking of what's up with energy? We head to the huge Zero Week Energy Conference. We'll hear from Lord John Brown, former CEO of BP, and John Ketchum, CEO at NextEra Energy, folks. So we're going to be front and center on the energy trade. That's coming up over the next 2 hours.
All that and more. First up, though, check of the day's trade and top business stories. Here's Charlie Pellet on this sell-off.
And here's what's going on. We've got 53 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ deeply in the red. No, I don't usually start with the year-to-date numbers, but do want to begin there because so far this year, Dow Industrials are now lower by 2.1%. The S&P on the year down 5.3%. NASDAQ is extending its loss year-to-date to 10.4%. A gauge of the Magnificent Seven mega caps has tumbled 6%. Tesla now extending its slump to 15%. Biggest drop since September of 2020. Apple stock we were just talking about trading lower. Now we got Apple down by 5.9%. Right to today's numbers now with the S&P 500 index down 203 points. That is a decline of 3.5%. Dow Industrials down 1,152 now. A drop there of 2.7%. NASDAQ down 4.9%. The NASDAQ 100 index down 4.7%. The 10-year 4.20% with the 2-year 3.88%. Gold down $28 the ounce, down 1%. West Texas Intermediate crude down 1.8%. And Bitcoin now slumping 6.5%. We've got Bitcoin at $77,100 on a Bitcoin. So what about the overall mood of the market? Barbara Reinhardt is Chief Investment Officer for Multi-Asset Strategies and Solutions at Voya Investment Strategy.
The problem is the stop-and-go nature of the administration's policy seemed to really be what's causing a lot of indigestion in the markets. And that also, coupled with softer survey data, earnings revisions have been marked down a bit, at least for the first half of this year. And it's causing a lot of problems. I mean, it was just on February 20th that we hit a new all-time high for the S&P 500. It feels like it was about a year ago.
And indeed, March 10th, we have got the S&P down 202, now down 3.5%. Recapping 10-year 4.20%, the 2-year 3.88%. Tesla bears repeating, down now by 15.6%. S&P down 3.5%. Keep it locked into Bloomberg Radio. We got you covered right through the close and beyond. Lots of reaction, lots of coverage, lots of analysis. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Well, we heard a lot about the equity market just now from Charlie. I want to talk bonds because bond traders are signaling an increased risk that the U.S. economy will stall as President Donald Trump's chaotic tariff rollouts and federal workforce cuts threaten to further restrain the pace of growth. We've got with us Michael McKenzie. He's Bloomberg News rates reporter. He joins us here in the Bloomberg Interactive Brokers studio. Michael, as you write, there was speculation that the president would pour stimulus on an expansion. It would keep upward pressure on Treasury yields. That is not at all what's happening. What's happening instead?
Well, investors have had to tear up the rule book. They came into this year thinking, okay, this economy is going to get pumped up a lot by deregulation, and that the Trump administration was going to be pro-business, and that's not really how it's panned out. And I think some of the data's come on the disappointing side, and you're beginning to get a sense here that the cuts in government spending. If you think back to last year, we had a big tailwind from government spending under the Biden administration. So even when the market started pricing in rate cuts last summer and the Fed duly delivered in September with a 50 basis point rate cut, lo and behold, the economy held up. And by the end of the year, the Fed was saying, we're pretty much done. So the market's now having to get its head around the risk of trying to price in the risk of, okay, if growth's going to slow, how much is it going to slow? And from discussions with a number of traders in the last week or so, it seems to be if the data continues to point to a deterioration, then the Fed's probably going to have to start resuming rate cuts at some point and probably gets the funds rate down about 3.5. And right now, that's where the market's pricing in, at least 3 rate cuts this year, which will get you down to 3.5. So that's kind of where we are at the moment.
Does the bond market equally reflect the nervousness that we're seeing in the stock market? I think we were talking with Mike McKee earlier, and he talked about spreads are still pretty narrow on different segments of the bond market. So does what we're seeing right now in the Treasury trade equate with the selling we're seeing in the stock market?
The other fact that's behind the rally we've seen in Treasury, so think back to in mid-January, we peaked at 480 on the 10-year, 460 on the 5-year. 10 years now back down to 420, and the 5 years is below 4% now. These are big rallies, and essentially that's reflecting the hit to risk assets. So when I was talking to investors at the beginning of this year, they were saying the one case for buying treasuries with the new administration coming in is going to be that if you get a hit to risk assets, you want to own the 5 to 10 year sector. That's really paid off, and that can continue to pay off if we continue to see more pressure on risk assets.
But are you saying then the moves that we've seen in yields already this year, the backing off, it's all of this nervousness already factored in, Michael? Or
to some extent, but I think you need another catalyst here. I mean, there's a lot more volatility in treasuries. The treasury volatility remains much higher than equity volatility.
Okay.
And that's just the constant having to sort of go back and forth with positions. We've been swinging around a lot in tight ranges to some extent, but the market is volatile and there is some deterioration in liquidity at the margin.
The 10-year 4.2% is the yield that we're seeing right now. Carol and I were talking about this earlier as we were preparing for this afternoon. Isn't this what Trump wants to see? He wants to see the 10-year yield fall?
It does, and I think what's interesting is talking to some bond investors lately saying this is an administration that they think wants short-term pain, longer-term gain. It seems to be an administration that says, look, we're going to make some cuts to government spending. You're going to have a bit of turmoil, a bit of sort of turbulence, but they are hoping that this will get the economy back on track. And one a key part of that is you keep rates down. So Scott Bessent has come out and said, I want lower 10-year yields. He doesn't want to specify to what level, but if you keep 10-year yields down, you are going to see more mortgage refinancings. And I think one thing that anyone who thinks that we're going into recession needs to ask the question, do you see balance sheet stress at the consumer and corporate level? If you don't, it's hard to make a case for recession. More importantly, though, look at the value of house prices today. You can now extract home equity from your house. So that will help buttress any kind of weakness we get in the economy. So I think the general tone of the bond market is the risks are rising, but we're not quite yet there to say, okay, this is a recession coming. That said, the real question here is the Fed going to actually look past potential inflationary consequences of tariffs and really look at a slowdown? And that's why the next couple of monthly payroll reports coming out are going to be very important for this market.
Is it just kind of interesting, though, Michael, that we went from earlier in the year, just nonstop American exceptionalism to all of a sudden we are using the recession word pretty regularly? Or
it's been bandied around. In general, talking to investors, they don't see a recession imminent. They don't really see this. And more importantly, though, think back to what happened last year. We had a big rally. So the 10-year last year, after September, the rate hikes, just before the Fed started, the 10-year fell all the way down to 380. But then it started rising again because, lo and behold, if you drop interest rates, it helps the economy.
Right.
Now, the question here is how much of a hit is this administration going to do with government spending? Bearing in mind, of course, that we still have Congress to decide on one big, beautiful bill. And lo and behold, if you're going to have tax cuts coming at the end of it, I would suspect the bond market could whip around again.
Seriously, that would be enough to make up all the tariffs and possibly more tariffs to come?
If you combine that with deregulation, if you now allow banks to buy more treasuries, if you cut all the red tape around small businesses, I think you could lay the case for a second half recovery. And then, of course, you have the problems of what is the ultimate inflationary impact of these tariffs that are coming through. I mean, I think right now it's a trade war that's really hurting sentiment. You're certainly seeing that on equities.
Yeah.
The Fed set to meet next week. What is the outlook and what's happening in the bond market signal about expectations for the Fed for this year?
Well, if we look at the March meeting, no one's expecting any move. I think the key here is May. We've been sort of dancing around pricing in about a 50% odds for a rate cut by May. So it's in coin toss territory. And I think you're going to have to see more. Obviously, you get inflation this week. Then you'll have another couple of months of payrolls and inflation to come before that May meeting. And that's, I think, will be the ultimate arbiter whether or not the Fed can go or not.
And if inflation comes in hot, that's not great news.
I think that puts the Fed in a really tough spot. I mean, I think at the moment they're okay, but they want to see inflation still trending down. They still want to see signs of disinflation. And if they get a hot number, that's going to complicate things, particularly if we see what happened in the last Friday's payrolls report. We did see U6 unemployment pick up. Mm-hmm. If that continues, then you're going to hear more chatter about stagflationary outcomes.
What are you watching regularly? Like, what's top of mind for you as we kind of go through this?
It's every tape bomb that comes out of Washington.
Yeah.
And from Donald Trump, I think that's because he keeps flipping around.
Right.
So
here.
Everyone's got this kind of, what are they really going to do? And it's that uncertainty that I think is driving people to say, you know what, I'm going to put my money in the 5-year Treasury. I think the 5-year Treasury will tell you it's below 4% today.
Right.
Couldn't get below 4% at the end of last week, but is now below 4%. So that's telling you that there's a bit of concern. There's a flight to quality trade going on. And I think that's the one thing to keep watching.
I thought he was going to say like White Lotus 3 or like Severance when you asked what he's watching.
I'm a big fan of Parker Posey, by the way.
She's great in that.
I loved her stuff back in the 90s with how...
You got to read I think, New York Times profile on her a couple weeks ago. It was just like,
White Lotus 3.
She's awesome, yeah.
You mean anything to step away from this?
Yeah. What are you watching? Anything I can right now.
Michael McKenzie, love. Bloomberg News rates reporter joining us here in studio. Hey, coming up next, we're going to just keep tracking this market and the selling, certainly on the equity side of things. We're seeing stocks hovering near their lows of the session, although rounding off the bottom. This is Bloomberg.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got 39 minutes to go ahead of the closing bell. As we have been discussing, we are off session lows. Our buyers, though, coming in to catch a falling knife with the Dow, the S&P, NASDAQ, all trading lower. We did have the Dow down 1,000 points or more at our last update. Right now, we got the Dow down 957, a decline right now of 2.3%. The S&P down 172. That is a drop now of 3%. NASDAQ down 4.3%. Year to date, by the way, the S&P is down by 4.8%. The 10-year 4.21%, with the 2-year 3.89%. Gold down $21 the ounce. Spot gold right now at $28.87, down 0.7%. A retreat for crude, $66.04 a barrel on WTI, down 1.5%, and Bitcoin down 5.9%, 78,185 on Bitcoin. Cara Murphy is Chief Investment Officer at Kestra Investment Management. She told us the selling comes down to policy uncertainty and valuations.
The good news is that the policy outlook can change fairly quickly. So we don't think that this is necessarily a long-term issue for the market, but there is some digestion that the market has to do, and we need to get back to this sort of area where we can have a good view about where policy is headed so that companies can then begin to plan.
Murphy was interviewed this morning on Bloomberg The Open. Reporting after the close of trading today, we will be hearing from Oracle. We got you covered on that stock. Oracle right now down 4.5%. Briefly, Tesla plunging, leading a tech sell-off today. We've got Tesla now down by 15.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pallett. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stenovic live here in our Bloomberg Interactive Broker studio on Business Week. And we are, of course, as Charlie is, as all of us, tracking what we're seeing in terms of the trade as we get ready for what could be the worst trading day for U.S. stocks in 2025, although I feel like we've said that already a couple times this year. But again, just to remind you, S&P 500 off its lows. So we're just seeing around off the worst levels of the session, but still down nearly 3% on the S&P 500 and the NASDAQ 100. Those big tech names, as we talked about with Gina Martin Adams, really taking it on the chin. That average is down about 4%, Tim.
Still, though, we are on the brink of a correction on the S&P 500. The NASDAQ 100, though, hit correction territory on Friday. It did sink as much as 4.5% today. The Mag 7, Carol, the gauge, the Bloomberg gauge of the Magnificent 7, tumbling 6%. A company like Tesla down as much as 15% earlier in the session, down 15.1% as we speak.
Got to say, you look at the S&P 500, 359 names to the downside, 144 to the upside. You look at the 11 major industry groups in the S&P 500, and you've got 9 lower at the bottom of the pack. Consumer discretionary, which is down about 4.25%. At the top, those energy names still up about 0.5%, and utilities up negligible, if you will. It's just up about 0.7 percentage point, or 0.07%, I should say. And then consumer staples, that's your third best performing group, but that group is down about 0.75%. But you look at those safer, more defensive plays. Hey, let's get into a little bit more about the market trade. Back with us is Bloomberg News senior editor Mike Regan right here in our Bloomberg Interactive Broker studio. We are rounding the bottom, Mike, coming off our worst levels of the session down, but the selling, at least it looks like some investors finding some opportunities here.
Yeah, I think that's somewhat encouraging to see a bounce off the lows right near the close here. S&P down as much as 3.6%, now down 2.8%. I mean, obviously still a nasty day, but I think, a lot of technically minded traders really hate to see the market close on those lows.
Right.
So to get a little bit of a pop here in the last hour, I think, is a little bit of a silver lining to this cloudy day.
We're seeing some big names lower. As I mentioned, the Mag 7 index falling as much as 6%, a little earlier. Apple's down 5%, Nvidia's down 5%, Tesla down 15%, Microsoft down 3.6%, Meta Platforms down 4.7%. The sell-off in big tech that we're seeing.
Yeah, it really seems to be, the most highly valued, and also the stocks with the strongest momentum coming into this sort of almost near correction that we've seen. And I think that's fairly common when, traders tend to sell their winners, sort of book those profits on the names that did the best. So not too surprising. I'm not sure there's really an economic signal you can extrapolate from that other than people are concerned about the economy. They're worried about the market as a knock-on effect of that. And really it tends to be these sort of strong momentum, highly richly valued names that you often see bear the worst of the selling on a day like this.
Well, talk to us about the technical trade too. Like when, you hit a certain level or you see a certain, right, we're down a little bit more than 8% on the S&P since their high in mid-February. I mean, how does that often kind of put a floor in, or how is it important that that does put a floor in versus, you continue to just take out one technical level after another?
Yeah, I think the one main big technical level that everyone's looking at today is that 200-day moving average, that long-term trend of the S&P 500. It looks like today we will actually close below it for the first time. It's something like, I read earlier, 360 some days or something like that. So a long time where we've had this trend line sort of be a support for the market. Again, if you're looking for a silver lining on that, though, one close below it doesn't necessarily, mean anything.
Right.
That trend line is still rising. Once the market gets weak enough where a trend line like that, it actually bends it lower and the market gets sort of stuck underneath it. That's kind of a really classic bear market signal. When that trend line is lower and is heading lower and the market's stuck under it. So far, knock on wood, not there yet, but it is very noteworthy to close below that trend line for technically minded traders.
That's a good point, because if you look at the trend line, right, it's still
kind of moving upward, yeah. So, if this weakness persists, it is flattening out a little bit. You could sort of drag that trend line lower. And then, markets that get trapped under that, or at least the S&P, tends to really sort of obey that trend line, at least in the short term, until there's some kind of catalyst to snap it out of it.
Hey, Mike, real quick, the S&P 500 down 8.5% from its all-time high back in February. If we hit that 10% correction, do we start to see any algos triggered, or is that some sort of catalyst then for the downside?
It's a good question, Tim. I can't say specifically one way or the other. It certainly is those type of levels are worth watching. It wouldn't be too surprising if we did see some sort of buy orders enter the market there. People thinking maybe this is a little bit gone too far. Can't say definitively that'll happen, but it is it's a good instinct to watch that type of level, that 10%, 20%, 15% type of move as at least an area that could sort of stop the bleeding for the short term. I think ultimately this market's not going to be risk on again until there's a little bit of relief from the main things it's worried about, which is higher inflation and slower economic growth because of the tariffs.
All right, watching the markets for us, our own Mike Regan, Bloomberg News senior editor. Mike Regan joining us here in studio. Right now, though, we want to head out west and check in with our own Sarah Fryer, because we just talked about the Mag 7, the Bloomberg Mag 7 Total Return Index down 5.4% at this hour. Every name is down. There's 7 in that index. Tesla seeing, there's 2 for Google, right? So let's just point that out. Tesla seeing the biggest hit, down about 15%. Sarah Fryer, I don't know. What are you hearing about, this tech trade today, which is obviously dragging down the overall market in a big way?
It's all about de-risking. I think that in times of volatility, you look at these stocks that have really just ridden on the optimism of extreme investment in AI. And there's been a little bit more caution around that lately. And I think Oracle earnings after the close will give us a little bit better view of what the future holds too. But when it comes to Tesla, you did mention that stock. I mean, that is also related to more than just the market. That's related to some of the fundamentals of the business, and also the connection with Elon Musk, the great amount of association that his own brand has with that brand, which causes some folks who make decisions on whether they want to get a Tesla based on what they think of Musk right now. And he certainly had himself in the headlines. So, beyond that company's performance and their deliveries, there's also some risk with his moves in government.
It's a really good point, and I'm looking at the chart, Sarah, of Tesla stock. It's at its lowest level going back to October 24th of 2024. So it's given up all of those gains that it had following the election of Donald Trump and, of course, Elon Musk's close association with the president. We also had some problems with X today, and Elon Musk himself saying that X is under attack, a cyber attack. Is it too much of a jump because X is not a public company? Is it too much of a jump for me to say, or for us to infer, that any of the reaction that we're seeing with regard to what's happening to Tesla today is also a reaction to people's concern about just security, Musk's role at the company, if he goes back to the company?
At a broad level, I would say, because it's this executive in charge of so many companies, maybe 6 at this point, who's spending all of his time in the White House and at Mar-a-Lago and keeping his eye off the ball in that sense. Some investors would prefer to see Musk take a backseat at the companies and just let them be run by somebody who can focus their full attention. Others, thought, with him out of the office, where is this inventive spirit? Where is that future vision coming from? Musk has a tendency to work late in the night. I'm not saying he can't pull it off, but we're starting to see it in the performance of his companies that we have an executive who is by all definition of the word distracted.
Hey, Sarah, there's a story that's just popped up on the Bloomberg, and it says, as of January 20th, billionaires including Elon Musk, Jeff Bezos, Mark Zuckerberg, who were present at Donald Trump's inauguration and had gained wealth due to frothy stock markets. Well, here we are 7 weeks later, and it says these billionaires have lost a combined $210 billion in wealth, with the S&P 500 losing 7-8% as we speak. It's probably a little bit more. It also says the companies behind the inauguration attendees' fortunes have lost a combined $1.43 trillion in market value since January 17th. It's probably a little bit more at this hour. There are tech CEOs meeting with the Trump administration. I don't know, what are you guys maybe waiting to hear from this meeting? One can only assume that lots of CEOs might be calling the White House at this moment to say, hey, let's talk about policy, but what are you hearing?
Across the board in tech, it has been about trying to get in the inner circle to try to make direct appeals to Trump on policy when tariffs come down. What can they do for their own companies when he makes decisions on AI policy? What can they do to ensure that they get the infrastructure built that they need to get built, that they have enough in the way of deregulation so that they can pursue what they need to do without the government preventing it from happening. It is a little bit like playing with fire, though, because a lot of these executives looked at Trump as a business-friendly president because he was more of a willing to pick the phone, honestly, and talk to them about the future and what they needed, willing to negotiate. And tariffs, inflation, all those things could make their stocks less favorable for the market.
All right, great to check in with you, Sarah. Thanks so much. Sarah Fryer, she is Bloomberg News Big Tech Team Leader out there on the West Coast. Folks, we're rounding off our worst levels, down still about 2.5% now on the S&P 500, NASDAQ 100, a decline of 3.4%. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. A slight bounce off the bottom, but the S&P 500 index still remains lower by 2.5%. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. It has been an ugly day for stocks with, like you said, even with this bounce off the lows, the Dow's currently down 828 points, was down 1,200. S&Ps are down 2.6%, while the NASDAQ is still off by 3.8%. The U.S. 10-year yield is at 4.22%. Gold and oil are in the red, and Bitcoin, that's lower by 5%. Among the main 11 S&P sectors, only energy and utilities were in the green. Tech and consumer discretionary were under pressure, and leaders to the upside in the Dow, Merck and Amgen, while Goldman Sachs and NVIDIA each fell 6% and led to the downside. In deal news, Redfin soared 63%. Rocket is buying the company for $1.75 billion. And in other news, Tesla is down as much as 16%. That's the most since 2020. Wrapping things up, Oracle reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg, type SQUA, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just about 18 minutes to go until we wrap up this trade on this Monday. Having said that, you just heard from Charlie and Bill Maloney. We are definitely off our worst levels of this session, kind of bouncing around here, but still down 2.7% on the S&P 500. Dow Jones Industrial Average, a decline of just shy of 200 points. We were down more than 1,000 points on the Dow at one point. Now a decline of 865 points. And the NASDAQ 100, which is dominated by that tech trade, it is down 3.9%, down 790 points.
Hey, curious what Max Wasserman thinks on a day like today. He's founder and senior portfolio manager of Miramar Capital. Max, you argue that the market is finally starting to recognize the risk of overvalued NASDAQ and the S&P 500 given the current market conditions. Is it still overvalued to you?
Well, thank you for having me on. And the answer is yes. I mean, the only thing that's surprising us is that we've been saying this for the past 6 months, that it took so long. But, the momentum has a funny way of turning on you. When everybody can justify, earnings going up in multiples of 31, 35 times on these large cap tech, when the market sours, it can take them right back down. So we think they're starting to recognize that the multiples are still too high on the NASDAQ. But we think the general market is not priced like that, and there's a lot of opportunity there. But given the fact that the NASDAQ 100 and the top S&P 500 stocks is pure NASDAQ, basically, this is why you're getting this major sell-off.
How were you prepared for today's sell-off? How were you invested ahead of this if you thought that, if this isn't surprising to you?
Well, we have been lowering our tech exposure for a while. I mean, we have investments. We're a dividend growth shop. We have investments in the Broadcoms, the Apples, and the Microsofts, but we were underweighted technology. We've been putting more money in the staples, which nobody wanted them, energy we like, and healthcare. You couldn't give healthcare stocks away. I mean, one of our largest holdings, like an AbbVie, is making 52-week highs. We just tend to think there was better value. We still like the growth in tech, but we're not willing to pay 30 to 40 times earnings for this.
So is this just a valuation reset? Is this just a potentially somewhat fundamental reset based on Washington policies? Or is this the U.S. economy starting to come undone?
I don't know if it's coming undone, or maybe we're just taking a better look at the U.S. economy. I think we're starting to say that the economy is showing signs of slowing down. And you have policies out there that are basically saying that they could hurt the economy. And if you go back to the fact that in December that the Fed told you that they're not going to be cutting interest rates, which Wall Street, desperately always wants, and because they had stubborn inflation. So there's a lot of things that are stopping that ignition of a further multiple expansion. I just don't think you're going to get multiple expansion. I think you're going to get a little bit of contraction, as it's showing, and the market's going to come back down to an equilibrium on where the fundamentals eventually show. But I think it's going to take another quarter or two for us to understand what are the tariffs, what is the unemployment really going to look like, what is the Fed really going to do. In the meantime, an uncertainty, who wants to pay 30, 40 times for these tech earnings right now?
Max, do you buy it that the president is not paying attention to the market, or rather maybe a different way to describe his comments over the weekend, saying that there would be short-term pain?
You know, it's very hard for me to get ahead of any politician.
People keep telling me that when I ask these questions.
Long term, there seems to be some inherent contradictions, but he did say that there could be some short-term pain, and his policies don't seem to be quarter by quarter. And for a president always just say he looks at the stock market, he's telling you he's not looking so closely. To me, it's the Fed. The Fed is telling you they're confused. They sort of want to cut interest rates, but there's stubborn inflation, and they don't know what inflation is going to look like with tariffs, if there's real tariffs, and how long they last. Because we don't know what the tariff looks like, because it's on again, off again. And we don't know if April 2nd is really going to be reciprocal, what's going to be excluded. But it's very hard to run monetary policy with all those uncertainties. And when the Wall Street wants Fed cuts, and they're not giving it to them just yet, I think more pressure is going to be put on the Fed to eventually start cutting interest rates.
Are you more of a buyer or seller in this environment?
Well, it depends. Right now, a lot of our stocks, to be candid with you, are running very strong. So our top positions are hitting some 52-week highs. So we're waiting here. I am looking through the tech rubble once we start to get a little bit more of a sell-off to just nibble here and there at good companies that are paying us dividends that we like. We still like some of the large cap tech. We just think they need to come down more. And we're starting to see it. I mean, we like the Googles of the world. We like the Broadcoms, and we like the Microsofts. But, you know, it's sort of, are we catching a falling knife? But, you know, for nibbling purposes, yes, we would start, because you're never going to time it perfectly. But when you have these great companies selling off 20% and still trading in the high 20s, low 30s, you could get another 10% here on the NASDAQ sell-off. But the equal weighted part of the market is showing strong signs. Look at the staples, look at healthcare, right? Look at financials that are taking a hit today. There could be some compelling valuations coming there.
I will note that there are 124 stocks in the U.S. right now, Carol, that are hitting 52-week highs. IBM, one of them. Another one is Tootsie Roll. Just thought that would
you gotta like chocolate, right? And we like Hershey, so it's the same thing.
Yeah, I mean, I'm looking at the S&P 500 equal weighted index, just down about 1.4%, so not as bad as what we're seeing in the S&P 500 at this hour. What about on the fixed income side of things? Are you anticipating that yields along the U.S. Treasury curve continue to go lower?
Well, that's the quandary. We've been telling people for the last 6 months, just focus on the short term, 1 to 3 years. We just don't think you're paid, because we still think inflation's stubborn, and we don't know. Do we think the 10-year could come down to 4? Yes, but I think it could equally go up to 4.85, depending on what the policies play out. So we just don't think you're being rewarded to go long term. We would still say stay short term, stay high quality. We still like U.S. Treasuries here. We still think they're not a bad value, because the spreads on corporates and even munis aren't just there to take the risk.
Yeah, that's something that, right, the spreads are still pretty narrow, correct?
Correct.
Speaking about the big picture of the market right now, do you think we're going to bounce off of this, and this is sort of the low of this most recent sell-off, or is there a move to go further down? You say things are still overvalued.
You know, I talked to some friends of mine. A really good friend of mine is a great trader, and he's telling me if 55.30 or something on the S&P could break through. And I'm listening to a lot of great technical analysts saying that you'll get a bounce here. It's hard for me to tell, because emotions can run to extremes, as we know it. I think emotions ran to extreme to bring the NASDAQ up so much for 2 years in a row, and it could take you down a little bit. I would look at this as an incredible opportunity for good companies. Find the companies you really like. Find the valuations that make sense, and you average into them. Right now, we're looking selectively for tech if they get sold off more. We need a little bit more of a sell-off there.
Hey, Max, just got about 25 seconds left here. How much have you been looking overseas? The Euro Stoxx 50 is still, it's up about 10% so far in 2025. Opportunity overseas, and just quickly.
Well, you know, we don't look much overseas because we buy such global companies and the currency risk. And sometimes I get very upset with the tax structure of how the dividends come back. So when we invest overseas, it has to be tax-friendly countries with us. And there's only a few countries that do that. So we're mainly buying domestic, global countries.
All right, got it. Hey, listen, good to check in with you. Max Wasserman, he's founder and senior portfolio manager of Miramar Capital, joining us from Northbrook, Illinois. Folks, we've got about 10 minutes before we wrap up the trading day. Again, we're off our worst levels of the session when it comes to the equity trade, but still down 2.7% on the S&P 500, a decline of 3.9% on the NASDAQ 100, the Dow, a decline of 2%. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we're just under 7 minutes to go until we wrap up the trade on this Monday, March 10th. Carol Massar, Tim Stenovec, live in our Bloomberg Interactive Broker studio. And yeah, I mean, I feel like nobody's saying panic in terms of the equity trade, and we are coming off our worst levels of the session. We've really seen that trade over the last half hour or 40 minutes or so. Still down 2.7% on the S&P 500. Dow Jones Industrial Average now a decline of 2%. Again, all of them off their lows of the session, and the NASDAQ 100, Tim, down about 3.9%.
There are still 25 stocks in the S&P 500 that are hitting 52-week highs today.
Yeah, I mean, and
AbbVie, you got BMY, you got Brown and Brown, you've got the CME Group.
How many?
25 in the S&P 500.
This is
Verizon.
Which is what Max Wasserman was talking about, right? Some of the names that he's investing in, he said we're hitting 52-week highs today.
Yeah. It's kind of crazy. You do have 17 hitting 52-week lows in the S&P.
Okay. But a little bit of context perspective, remind everybody, right, that we say we've been on such a tear over the last 2 years, certainly in 2023 and 2024, tremendous run-ups in U.S. stocks, a lot of it led by those big tech names. Having said that, the environment a little bit different, and I think investors are trying to assess the impact of tariffs and what that means for individual companies, as well as what it means in terms of higher prices, inflation expectations, and what that might do to overall growth of the U.S. economy.
Hey, and like Bill Maloney, I don't know if you said this on air, if he was telling us before he went on air, but we're bouncing off the lows today, and if we don't, if we don't close. And we don't see selling into the close. It's kind of a good sign, at least in the short term.
Yeah, absolutely.
That's what a technician would say. I'm channeling a technician.
You channel
Don't throw anything at me, anyone, please.
Do not throw. VIX, by the way, up almost 5 points, 28, just about 28, the level. And I was reading on the live blog that it said that when you see the VIX hit something like 30. While the VIX may not be at a level that indicates a bottom just yet, it's quickly approaching 30, which has seen stocks find their footing in the days that followed. Prior spikes to 30 or higher in the last 4 years since the pandemic have been followed by a rebound in the S&P 500 in the following 5 sessions by 1.7% on average. So, I mean, there's a lot of things we're trying to assess where we go from here, but we'll see. Time will tell, right, over the next week.
I'm going to do it because this is one of the stories that is about the moves that we're seeing today.
Go for it.
Strategy, formerly known as MicroStrategy. Those shares are on track to fall nearly half from their peak as investors fret about economic headwinds and retreat from crypto-related bets that had initially benefited from Trump's election win. Down 16% at one point today, a little earlier in the session. If the decline holds through the end, it's going to have lost 49% of its value since closing at an all-time high. That was back in November.
It's a lot. I mean, Tesla's down 16%, right?
Yeah.
Palantir's down 11% today. You mentioned Microchip, right? That one is down about 12%, almost 12% in today's session. But we do have 156 names in the S&P 500 actually gaining ground as we speak. So it's not like every name that's out there. Energy has been a group in a major industry group in the S&P 500 that's been holding on to some gains. It's up about 0.6% as we speak.
Okay, I'm taking a look at the Mag 7, the Bloomberg Mag 7 index. At one point today, Carol, it was down more than 5%.
Yeah, right. And, and then let's not forget, right? We keep a watch on the equity markets. That's one thing. But also in terms of whether, the Treasury trade, the U.S. Treasury trade is talking or showing any kinds of signs of recession. We talked about it with Michael McKenzie. Still, again, not some panic, but the 10-year down to 421, shorter end of the yield curve, that 2-year note specifically 389. Don't forget, we've got a Fed meeting and decision, or not expecting any kind of rate moves next week from the U.S. Central Bank.
Okay, that Bloomberg Magnificent 7 index down 5.3% right now. At one point in the session, it was down as much as 6.5%.
Yeah, so something to, just kind of keep a watch on, right, in terms of perspective. We'll see what we get. We've got about 2.5 minutes to go. Do we see investors come in and maybe do some cherry picking in terms of now stocks that are now 2 or 3% cheaper or more than they were at the beginning of this session? We'll have to see, but do not go anywhere. We're going to head over to our TV colleagues and count you down to the close on this Monday. The closing bell starts right now.
Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu, taking you through that closing bell with a global simulcast that starts right now. Tim Stenovic and Carol Master joining us in the radio booth. Alex Steele is on assignment on this day here. Stocks deep in the red, though off the lows of the day. 57.0537. Carol, was where we opened. And that was the high of the day.
Yeah, pretty remarkable. I think what's interesting, though, over the last half an hour, though, we have seen stocks come off their worst levels. I think it's really interesting to see whether or not we continue to see buying into the close. We've just got about a minute or so to go, or whether we start to see another leg to the downside.
We should know not everything is down today. If you look at the S&P 500, there are 25 stocks in the S&P 500 today that are actually hitting 52-week highs. Verizon, one of those. Altria, another one of those. AbbVie is hitting a 52-week high today. So is IBM.
Yeah, so some defensive buying, but when it comes down to it, the number everyone's looking at is a 200-day moving average, or I should say the line, and everyone's talking about how nothing good happens below the 200-day moving average. We could be closing below that level, and if we close again below that level tomorrow, a lot of people saying that puts us in a new regime.
Yeah, well, it certainly looks like we are going to close below it here on this day. 57.34 is your 200-day moving average. The S&P right now at 56.07 and change, and we should also point out the index right now poised to actually close in oversold conditions for the first time in about a year and a half.
Yeah, pretty significant, right? Yeah. And, this is when you wonder, do buyers come in at this point, or do they kind of wait to see how it plays out over the rest of the week?
Yeah, hard to do that, of course, when you continue to hear this chatter out of Washington saying, look, folks in the White House, they don't care what the market's doing. They're playing the long game on the economy. It'll be interesting to see whether that actually comes to fruition. The closing bells in New York as people are obligated to chat and cheer, with the S&P down more than 150 points on the day, or roughly about 2.7%. The Dow Jones Industrial Average down almost 900 points, or 2% on the day. The NASDAQ Composite is going to close lower by 700 points, or about 4%. Similar move lower on the NASDAQ 100. And the Russell 2000 also being dragged down on the day, down 56 points, or 2.7%.
All right, quick check on the S&P 500. You had 341 names to the downside, guys, 162 to the upside, Scarlett.
And given that the S&P closed down about 2.7%, you would think that all 11 sectors are in the red. That's not the case. Utilities gaining more than 1%. Energy also holding up by about 1% as well. Of course, they're among the two smallest sectors in the S&P.
All right, let's get to some of the individual gainers, guys. Redfin, no surprise, up 67%, right? Rocket is buying Redfin, an all-stock deal, $1.75 billion is a price tag on that. Rocket paying $12.50 per Redfin share, so no surprise to see this one. Biggest intraday gain, probably biggest gain in total on record for that name. Another name actually gaining in today's section, Tractor Supply, at one point up 5%, but finishing the day with a gain of about 0.5%. Business Insider noting over the weekend that Mizuho analyst saying that faced with U.S. egg prices at record highs, shoppers are turning to Tractor Supply in large numbers to buy baby chickens of their own. So we did see a lift in that one. And Cracker Barrel, guys, up about 3.5%, being raised to a buy from hold over at Truist Securities, which views the company's solid results in the last 2 quarters as a sign that its turnaround plan is gaining traction. They upped the price target to 55 from 51, stock closing at 44 and change today.
All right, you got the gainers, Carol. I got the decliners. I do want to start with the shares of Tesla. Its worst day going all the way back to September of 2020. Shares falling by more than 15%, reaching their lowest level going back to October of last year. And yes, that was before the U.S. election. Shares dropping today by 15.4%. Growing concerns about the company's deliveries. Joseph Spack over at UBS cut projections for the first quarter and the full year, expecting a 16% reduction in deliveries this quarter and a 5% annual drop next year. You got to wonder if shareholders are going to start demanding that Elon Musk get back to Fremont, California, or maybe Austin, and work more on Tesla. We'll see if that happens. Hey, shares of Apple also selling off today. All members of the Mag 7, Apple no exception. Apple, worst day going back to September of 2022. Shares down by close to 5%. At one point, it was the worst day since 2020. Separately, Apple did say it was delaying an AI-related update to Siri for the foreseeable future. And then this afternoon, Mark Gurman out with a Bloomberg exclusive, citing people familiar that Apple is preparing a major software overhaul to transform the interface of the iPhone, the iPad, and the Mac. The idea is that it makes the OSs more consistent and will simplify navigation.
A lot of moves.
Yeah, go ahead.
Go ahead. Go ahead, Al.
I was going to say, just finally, shares of Novo Nordisk down by 9.4% today. Those are ADRs. Martin Lang, I saw him on your air, EVP for development. We should note that Novo shares fell after the company's next-gen shot failed to meet expectations in a trial. Patients did lose 13.7% of their weight over 68 weeks.
All right, let's get a quick check on yields here. There was a lot of activity there, particularly on the short end of the curve, down 10 basis points on your 2 and your 5 year. Of course, the 2 year most sensitive to conditions, to Fed conditions, I should say, or changes in Fed rates. You had an 8 basis point drop on the 10-year yield and about 5 on the 30-year yield. And speaking of Fed conditions here, we talk about this idea of what the Fed might do next, guys. I mean, we've all been sort of focused on work. We came in, just barely a month and a half ago, and you had a market that was pricing in barely a quarter point of cuts all year long. Right now, that is more than 3/4 of a percentage point now being priced into this market. To be specific, right now, 83 basis points by the end of the year. So a big turnaround just in the past 6 weeks in expectations for Fed cuts.
And yet the expectations for next week, when the Fed meets and puts out their latest views on monetary policy, they are not expected to cut rates. But it will be interesting. We get another read on inflation this week, and whether or not it becomes trickier for the Fed, especially if we see or continue to see signs of slowing U.S. growth, and if inflation continues to be sticky. Once again, we bring up this idea of stagflation and how it makes it more difficult for the U.S. central bank.
Yeah, Michael McKenzie, who covers rates for Bloomberg News, was on our air a little earlier, and he said, obviously next week's meeting, not really seen as a live meeting, but investors kind of looking to signals that we get about what happens at the May meeting as a potential meeting for some rate movement.
I suppose the silver lining here is that a lot of people, economists, are anticipating CPI increases to slow for the month of February. Right now, we're looking at 2.9% year-over-year growth in consumer prices versus 3% in the month of January. And when it comes to University of Michigan consumer inflation expectations, that too is decelerating just a bit.
And what's interesting too about all this too is this idea, and we're speaking with Amy Wu Silverman at the top of our show, who's talking about this idea. A lot of this stuff hasn't actually shown up in the data yet. Gina Martin Adams echoed that, and that's going to be a big concern right now, is that there's all these fears out there, but at least as far as the hard data, not showing up just yet.
All right, let's get to Oracle, just coming out with its latest results. Third quarter adjusted operating margin, 44%. That's a little bit better than what the street was expecting, 43.6%. Adjusted revenue, $14.13 billion. That compares with an estimate of $14.39 billion. And third quarter adjusted EPS, guys, $1.47 a share. That's 2 pennies light. And you do see the stock down about 2/3% here in the after hours. All right, guys, that is a wrap. We'll continue to track some of that earnings after the close. That's a wrap on radio, TV, YouTube, and Bloomberg Originals. We will see you again, same time, same place tomorrow for the closing bell.
This is Bloomberg Business Week, insight from the reporters and editors that bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. That's Carol Masser. I'm Tim Stenivek. You did just hear Carol give a quick update about Oracle. I'm looking at shares right now, bouncing around. They were higher, they were lower. Now they're higher again. Investors in the after hours can't make up their mind. Third quarter adjusted revenue did miss the average analyst estimate. Adjusted revenue coming in at $14.13 billion. The estimate was for $14.39 billion. On the bottom line, adjusted earnings per share came in just shy of estimates at $1.47, whereas the estimate was for $1.49.
Yeah, and we are seeing the stock right now up about 0.8%. The real key ones in terms of the headlines, third quarter adjusted revenue, again, a little bit light, $14.13 billion. The estimate on the street was $14.39 billion. Third quarter cloud infrastructure revenue, of course, important to the company in a big way, $2.7 billion. That's a slight beat. The estimate on the street was $2.71 billion. And the company also boosting their quarterly cash dividend to 50 cents a share. The street was looking for 48 cents a share. And again, as Tim mentioned, rightfully so, this stock is bouncing around a little bit here in the aftermarket. Just right now, maybe up a hair, up, call it flat right now.
Hey, this is interesting. Larry Ellison, chairman and the CTO of Oracle, quote, "We are on schedule to double our data center capacity this calendar year. Customer demand is at record levels. Our database multi-cloud revenue from Microsoft, Google, and Amazon is up 92% in the last 3 months alone. GPU consumption for AI training grew 244% in the last 12 months. And we are seeing enormous demand for AI inferencing on our computers' private data.
So does this mean they couldn't meet demand, and that's why there's some disappointment with some of the revenue numbers? Because it sounds like they're still optimistic about the build. But as we mentioned, adjusted revenue for the third quarter was a little light, up about 6.4% year over year, and adjusted EPS was 2 cents light. Cloud revenue was a little bit light, so cloud infrastructure revenue was pretty much in line, but you do wonder, we'll see what kind of color we get about that demand, because if they're continuing the build, sounds like they anticipate the demand will be there.
I just cannot believe this, what we're getting from Oracle in terms of demand here. He said, we're connecting OpenAI ChatGPT, XAI Grok, and Meta Llama directly to version 23 AI of the Oracle database with advanced vector capabilities. The company also out saying that the board of directors declared a quarterly cash dividend of 50 cents per share of outstanding common stock. And they did note that Larry Ellison, who is the largest stockholder, did not participate in the deliberation or the vote on this matter.
Yeah, so interesting, right? In Oracle, we are also seeing Safra Katz say we expect RPO to continue to grow. That's recovery point objective, which is, I am Googling this because this isn't my world, but it's the maximum point of data loss.
I'm just glad you're not looking at me for it.
It's a key consideration in disaster recovery planning. So how much data loss can be tolerated. So giving some color around that. Again, Oracle shares, folks, just down about 0.9%.
All right. Well, right now in Houston, CERAWeek by S&P Global is taking place. It's one of the biggest energy conferences of the year. U.S. Energy Secretary Chris Wright spoke already. We heard from executives such as Joe Dominguez, CEO of Constellation Energy, and Saudi Aramco CEO Amin Nasser. Bloomberg TV's Alex Steele is live at CERAWeek now, sitting down with another CEO, John Ketchum, CEO at Next Era Energy. Alex, take it away.
All right, thanks so much, guys. We are joined now by John Ketchum. He's the CEO of Next Era Energy. For some background, Next Era is the largest renewable company in the United States. It's focused on solar, wind, battery storage, and green hydrogen. John, it's always a pleasure to catch up with you.
Great to be here, Alex. Thank you so much for having me.
You bet. Tough day in the markets. Lots of fear about tariffs, lots of fear about recession, more economic pain before any other kind of gain. Are you seeing any signs of this in your market?
We're not. We planned for this. So from a wind standpoint, 90% of our wind turbines made in the USA. We've converted our battery purchases to almost all predominantly in America. And from a solar panel standpoint, we diversify our buy around the world, but we're also increasingly pivoting to the United States.
So if we do see tariffs go up on Wednesday, aluminum, steel, 25%, does someone call you and say, hey, look, I got to charge you more, or no?
No, we don't. We'll get some of those calls, but it doesn't impact our generation costs. Those costs are absorbed by our suppliers through our contracts. The only area where we could see some additional expense would be in the transmission area, where we do use a lot of aluminum and steel in the poles, but it'd be a modest impact.
What about the demand side? So lots of worries about recession, weakness in economic growth. Are you seeing any signs of that?
We're not. We're projecting demand to increase sixfold for power over the next 20 years compared to the prior 20. And we think that demand is going to have to be met by all forms of generation, which is a perfect fit for a company like NextEra, because not only are we the world's leader in renewables, but we also have the largest gas-fired generation fleet in the United States. Nobody's built more gas-fired generation in the last 20 years than NextEra. We're the 7th largest nuclear operator in the world. We're in upstream oil production, we're in midstream, and we have a leading competitive transmission business.
I just spoke to the Secretary of the Interior, and they're looking at leases of solar on land. They're looking at online wind leases, offshore wind leases that have already been doled out, where contracts could already be happening. Are you worried that all of a sudden the government's going to come to you and be like, John, shut off those solar plants?
We haven't seen that, and right now is not the time to pivot away from renewable energy, and here's why. Because again, nobody's built more gas-fired generation in this country in the last 20 years than NextEra. What we're seeing in the market for gas build from our customers is a lot of demand. But with that demand has come a stark increase in prices for gas-fired generation. It's increased threefold because the turbine's more expensive. It's really hard to get labor to build combined cycle facilities because we're competing for skilled labor with data centers, with semiconductor chip manufacturers, chemical companies, oil and gas refineries, and the electrification of industry. And so labor costs have gone up substantially, driving the cost of gas up from our last plant built in 2022, $785 a kW. Today, to build that same plant, $2,400 a kW.
Wow.
So gas-fired generation prices have gone up over $100 a megawatt hour, making it extremely expensive. So we've got to be careful here in terms, or we'll have a real affordability problem in this country. We're going to need all of the above, but we've got to be careful not relying on just one generation class, that being gas-fired generation. We're going to need renewables to get us to 2030 and beyond. And when the gas shows up and the nuclear is a ways out, that won't show up till 2035 or later.
Well, let's talk about that. So you guys are exploring restarting the Duane Arnold nuclear facility. We saw that with Constellation and 3 Mile Island. They got a nifty agreement with Microsoft. It was a complicated negotiation and contract process, but what are you going to restart the plant? What are those conversations like? Who are you talking to?
So Cedar Rapids is a hotbed for data center development. So we're talking to a lot of different hyperscalers. There's a lot of demand for that facility. So we need to get the contract in place where we can get that signed, get the revenues to support the recommissioning, and then make sure that we firm out the cost estimates. But again, back to the tax credits, we need the tax credits in order to build that plant, because those are a big part of, you know, helping out with the economics, which will provide a real growth engine and much needed power supply for hyperscalers in that area.
How hard are those conversations right now with hyperscalers to come to a price?
Right now, there's a lot of demand because AI is just getting started. We're in the early innings of artificial intelligence. We want to globally dominate that market. So there is a lot of demand, particularly for nuclear assets to help serve those data centers. Also for renewables. Data center developers want renewables to power their facilities and gas. So it's really, again, all of the above. And what's interesting is in Congress today, what we saw were 21 House Republicans signed on to a letter that went to Chairman Smith and Chairman Crapo on the Senate side saying, please don't touch the tax credits for wind, solar, or battery storage. Don't touch the ability to transfer those tax credits because they're essential to keeping utility bills low and driving investment. And as an example, NextEra is investing $120 billion over the next 4 years during the term of this administration. 80% of that investment is going into Republican states.
Okay, so what you're talking about specifically is the tax credits within the IRA that benefit wind and solar, maybe some nuclear also, but a lot of hydrogen also is a big benefit. And the worry is if you repeal the IRA in some respects, those tax credit goes away and puts the kibosh on a lot of certain projects. Are you talking to the administration? What's your level of confidence?
Yeah, we are talking to the
administration. Are they listening?
We are talking to the administration, and yes, they're taking our meetings. They are listening, and the big message that we're bringing is, look, don't take any options off the table. If we take renewables off the table and the gas doesn't show, fire generation doesn't show up till 2030, nuclear till 2035 or later, the demand is here right now. It will go unmet. And we all know if we don't provide supply of generation to meet that demand, prices only go in one direction, and that is up. And again, the credits, we are legally obligated at Florida Power and Light, the largest rate-regulated utility in the U.S. that we run, to flow those credits back to customers dollar for dollar. So it actually reduces their utility bill dollar for dollar. We've done a national study. Because of the credits, household income across the U.S. is up 12%. If you take those credits away, that's a 12% tax increase on Americans across the board.
I do have to say, after talking to the Secretary of the Interior, though, it doesn't feel like there's a lot of love for wind and solar.
Well, the message that we're bringing forward is we're going to need it. Because if we don't have renewables to answer all the demand that's coming, again, that six-fold demand over the next 20 years, we're going to get caught short without adequate power supply in this country to meet that demand, which is going to put a lot of pressure on utility bills. And the last thing we want is inflation driven by power prices in this country, which is what we'd be looking at.
Before I let you go, what do you think the data center world's going to look like? Is it going to be you building a plant for a data center on site? Is it going to be that hyperscaler moving to where you already have power and a direct hookup, or is it just going to be flooding the grid with stuff?
Yeah, it's going to come in two ways. I mean, one conversation we have are what I call islanded solutions, where we can build right at their site, provide them with a multi-gigawatt power solution, whether it's through renewables, gas, nuclear, a combination of all of the above. But that's a little bit more expensive because you have to build in a lot of redundancy if you're not connected to the grid. Most hyperscalers would prefer to be connected to the grid to have that reliability backup to their data center. So it's going to be a three-way conversation between a NextEra, the data center provider, and the local utility in that area. And we have 20 years of utility relationships. Nobody's better positioned to be able to deliver that solution than NextEra.
But it's complicated, as you're saying. All right, John, really appreciate it. Thank you very much for joining.
Alex, always a pleasure. Thank you.
You're welcome, John Ketchum. He is a NextEra CEO. Back to you guys.
All right, Alex, thank you so much. That is our own Alex Steele. She's live at CERAWeek with John Ketchum there, CEO at NextEra, I should say, Energy. And if you missed any of that conversation, great in terms of one of the themes that we talk about. Yes, we had the market selling, but energy was an outperformer, and increasingly you hear about the increased electrification of our world and the increased energy needs. So some really important voices there.
Hey, if you want more on energy, stay tuned, because she's going to be coming back to us with Lord John Brown, former CEO of BP, a little later in our program. Also, check out our live blog, T-Live, on the Bloomberg Terminal. CERAWeek Day 1, some highlights include Energy Secretary Chris Wright saying tariffs effects on crude too early to call, and the European Commission Energy Director criticizing Russia's energy, quote, weaponization.
I'm looking at our live blog, speaking of that, for our markets live blog. And the NASDAQ 100 has fallen nearly 4%, worst day since 2022, closing at the lowest in September. S&P having its biggest fall this year, down about 3%. And we had Tesla dropping 15%, the biggest tumble since September 2020. The rest of the Magnificent Seven also slumped. But, you know, we did a segment last week looking at Tesla. Like, at some point, do investors come in and look at what has happened to the share price and kind of, you know, it's not the first time that people have said Elon has a full plate. This is what he does. But you do wonder at some point, do investors, you know, kind of want to, I don't know. have some questions for him.
Elon's a different animal, right? Because he has so many companies and he has been able to focus on so many different things. Hey, speaking of the sell-off, I want to bring back in Bloomberg News senior editor Mike Regan, who joins us here in the Bloomberg Interactive Brokers studio. So, Mike, we got the final scorecard for today. Red across the screen, the NASDAQ Composite down 4%, the S&P 500 down 2.7%, the Dow down 2.1%. It did shed 890 points. It didn't finish off. These indices didn't finish off the worst levels of the day, but this was some serious damage if you're long this market.
Yeah, absolutely. And especially you look at year to date now. I mean, the NASDAQ Composite down almost 10% year to date already. S&P off about 4.5%, you know, down about 8% from its last record. So, you know, certainly an ugly, ugly day. I mean, I do think, you know, again, to use that silver lining for the cloudy day, that bounce off the lows is something.
That's who said it. Sorry, that's who told us. I was saying, I know we talked to somebody who said if we don't close at the lows of the session and we see it bounce and we don't see selling into the close.
Yeah.
Okay. I thought it was Bill Maloney. Maybe he said it also.
Yeah, I mean, I think it's something that does give a little bit of confidence to bulls. I mean, I wouldn't say it guarantees, you know, this is the bottom or that we see you know, a rally rebound tomorrow, but it is one of those sort of check the box things. You know, I think there'd be a lot more sort of hand wringing and concern tonight if we had closed right near the lows of the session. So to get a little bit of a bounce, I think allows traders to exhale a little bit. And again, it's no guarantee of anything that the trend's reversed or that we'll see a rebound tomorrow, but it is, you know, better than the alternative, whereas, you know, you're saved, you know, a nasty day is simply saved by the closing bell.
I love on the live blog, the Markets Live blog, they say, you know, no secret that buying into tech weakness has paid off handsomely in recent years over a longer horizon. 1 in 3 month forward returns only confirm that. They show back in September of 2022, I guess the S&P was down about 1.5%, and then 3 months later, well, maybe that's not a good example. I'm just looking, I guess it's some of them, May of 2022, some selling, and then we saw 3 months later it was up about 11%. So, this has been a trade that we've heard over and over again, right? Buying into the weakness, especially for tech.
And those big tech stocks, especially. I mean, I've been doing this job for I don't know how many years. It's never been a wise idea to bet against tech in the long term, But that said, I mean, this is obviously a noticeable dip, and how long it lasts, how long tech continues to bear the brunt of the selling is anyone's guess. But it's hard to ignore just this very fierce correction we've seen.
And I think it's fascinating that Oracle, which came out with its latest numbers, and the stock was bouncing around, but right now it's up about 5.3% here in the aftermarket in what has been a down market day. And this one, third quarter adjusted revenue came in just a hair light. But we are reporting that it's given a strong outlook on cloud and, reported a surge in bookings and gave a revenue forecast for the fiscal year beginning in June that topped estimates. I guess my point is, Mike, you have been doing this a long time, and they're the overall market indices, but if you dig deeper, as Tim's been pointing out, there were stocks that hit 52-week highs today, and not every name was down across the board.
Yeah, definitely. I mean, if you take a name like Oracle, if you give someone sort of a reason to buck the trend, I mean, they were down big today, now have recouped all the losses and are higher, at least in the aftermarket trade. I mean, a lot can happen between now and the open that could sort of evaporate that. But look, I think that is another sort of reason to find some solace in this market is we do have utilities up pretty strong, energy up. So, a bit of a rotation more than like that sell everything type of trade that sometimes you see at times like this. That said, I mean, I really think, it's really the comments coming out of the White House over and over again really lead or sort of informing the investing public that, look, sort of buckle your chin strap here. We're not really going to come to the market's rescue and redo any of these policies just to please the stock market or to avoid some first quarter numbers that are going to be ugly. So, and you hear more and more this sort of shifting the blame. The White House is trying to shift the blame to the Biden administration and say this is Biden's economy that they've inherited, which I think...
We did a whole segment on this with Mike McKee about what's the Biden economy, what's the Trump economy.
Yeah, well, the jobs report was the Trump jobs report, according to...
Mike?
Well, no, according to the folks from the White House who came and talked about the strong... certain strong portions of it.
It's not the clear delineation is a little tricky.
Well, and it's maybe there's a little bit of spinning going on to sort of
in politics. Spinning? Come on!
I hate to be the breaking news here, but to blame the last guy. But clearly they think they can get away with blaming Biden for some sloppy market action and for some weak economic data in the first quarter. So their perspective gives them cover for some bad numbers in the first quarter.
All right, Mike Regan, thank you so much for guiding us through on this market day. We really appreciate it. Bloomberg's Mike Regan.
Well, the Business Week Women in Leadership segment is brought to you by Visa and Visa Foundation, connecting small businesses to the digital economy. Today, and especially International Women's Day, they are committed to uplifting small business for growth.
All right, folks, some news in the world of real estate today. Blackstone Mortgage Trust is preparing to sell its first collateralized loan obligation since 2021. I know. Wild.
CLOs,
a $1 billion deal that shows the real estate investment trust pivoting away from its focus on office properties. So interesting development.
Okay, this CLO is going to be backed by roughly 90 properties, and over 85% of the total dollar value will be comprised of apartment complexes and hospitality and industrial properties. That's according to people familiar with the matter. This by our own team at Bloomberg News.
Yes, indeed. For more on real estate, we bring in Tamara Bowens. She is President and Chief Operating Officer of the Dawson Company. Based in Atlanta, it's a real estate services firm that, in its own words, has developed, renovated, and or managed 5 million square feet of office, 1.5 million square feet of retail, and 15,000 and growing units of attached and multifamily housing. The company has projects in Bethel Park, Pennsylvania, Pensacola, Florida, and has completed many projects throughout Atlanta, Baltimore, Cincinnati, and more. She joins us from Pensacola. I mean, you have a great vantage point in terms of some of the real estate that's going on, certainly on the commercial side of things. Talk to us, first of all, big picture, how you would describe the real estate market. And you can be as specific, because I know geography makes a difference when we're talking real estate.
Yeah, absolutely. So, as you probably have figured out, it's very complicated today. From our vantage point of development, we're really focused on, building communities. So back in the day, you could just build an apartment complex and move on to the next thing. Is more sticks and bricks. Now it's more about building a holistic community and putting those features and amenities that the marketplace wants. When you're specifically talking about development, which is our bread and butter.
How, are you seeing specific, and as Carol mentioned, you've got projects right now in Pennsylvania and Pensacola. You've done projects in Atlanta, Baltimore, Cincinnati, and others. Geographically, where are you seeing areas of strength and where are you seeing areas of weakness right now?
It was very interesting. So our main focus right now is Pensacola. Pennsylvania was long ago, or Philadelphia was long ago. But, like I said, Pensacola is our market focus right now. And what we realize is that, even smaller cities want what big cities have, right? So it's no longer building to the lowest common denominator, but it's really about elevating the status and the stature of what you build. So, I think there was a thought process before that smaller towns and cities wanted different things from big cities. What we're seeing now is this migration of the things that exist in a city like in Atlanta, like in New York City, are also welcome in these smaller cities. And that's exactly what we're doing as a company. We
spent a good portion of our earlier part of our program talking about rates and where we're seeing, not where we're seeing, but where bond investors are seeing the 10-year go. How dependent is your business on rates?
Rates are coming down. They're not coming down fast enough, of course, and it makes it more expensive to develop and to build. But if you're in the right market with the right fundamentals, the money will come. We're actually right now in the process of doing a public-private partnership in the city of Pensacola at a property called Maritime Park. So it's a city park that we have the rights to develop 5 pad-ready sites. Right now, we're under contract to build a Reverb by Hard Rock Hotel, as well as luxury lofts. And then that'll be quickly followed by other lots, which will have an entertainment complex, as well as a luxury high-rise and a luxury hotel as well.
So I want to go back to what you said about rates coming down faster. Do you see rates coming down faster because of concerns about a recession? Because if rates start to come down pretty fast, that means the Fed's going to be a little bit concerned about economic growth. Is that what you anticipate?
I don't have a crystal ball, but what I was really meaning is from a development standpoint, of course, we want rates to come down faster because money then is cheaper. But, as far as the speed in which it will happen, like I said, who knows? But I definitely think that you'll see some movement, but it won't be as fast as anybody wants to happen.
You guys also partner with large asset managers to raise money and finance these projects. How has it been, the fundraising environment, over the last couple of quarters, and how has it been this quarter?
Actually last year we were really knee deep in trying to raise money, and it was definitely more difficult. I feel like the purse strings are loosening up now, and so it's becoming a little easier. Like I said, we work with investment banks, and as we're looking at this property from this development at Maritime Park, we're definitely getting some traction faster than we got on past developments, for sure.
What's the most difficult part of developing right now? One of the things that we often find when we talk with developers is, regulations, permits, getting things done. It just takes a lot of time. The markets that you're working with, are you finding them problematic, or is it fairly okay and easy to get things up and running?
I think for us, especially being in Pensacola, it's an education process. So if you think about Pensacola, it's in the Panhandle. People think of the Panhandle as a redneck Riviera. They think about 30A. Pensacola is so different from that. And so it's just a constant education of what Pensacola is, the amount of investment that the government has, in the Air Force there. You think about it being, most people don't know that Pensacola is really steep in healthcare and STEM technology, which is driven by the naval bases there as well. And just, it's a young population, and it has, it's growing by gangbusters. So I think for us, being in Pensacola, it's really more of an education process. And then when investors understand the market, it becomes so much easier to have the conversation and to get the investment.
All right, got to run. Tamar, thank you so much. You are President and Chief Operating Officer of the Dawson Company, joining us from Pensacola, Florida on this Monday. We got some news crossing the Bloomberg.
Yeah, let's go to the skies because we're seeing shares of Delta Airlines just crater, I wanted to say, in the after hours, down about 9% as we speak. The company cut its profit expectations roughly in half for the first quarter as demand for air travel softens. Earnings, the company says, will be 30 cents to 50 cents a share in the period, down from an earlier forecast of as much as $1. Delta said in a statement. Delta's share, again, shares falling in post-market. You're watching other airlines? Are they moving?
Got American down almost 4% here in the aftermarket. United, it is down 5.3% in the aftermarket. JetBlue just down about 0.8%. But really the majors, as you mentioned, Delta down 9%, American down 3.7%, and United a decline of about 5.5%.
Okay, well, let's go to Texas now, back to Houston, where CERAWeek by S&P 500, S&P Global is taking place. It's one of the biggest energy conferences of the year. Alex Steele of Bloomberg TV just spoke with John Ketchum, CEO at NextEra Energy. She's sitting down with another big name in energy, Lord John Brown, former CEO of BP. Hey, Alex.
All right, guys, thanks a lot. I really appreciate it. It's a tough tape today, to be sure. Laura John Brown, yes, former CEO of BP, but also now chairman of Beyond Net Zero. It's a climate growth equity venture established in partnership with General Atlantic. Also a tough tape for anything Beyond Net Zero right now. Great to see you. Thank you so much for being here, John.
It's a great pleasure.
Markets were falling out of bed. Oil prices are lower, excuse me. Everyone seems to be panicking about growth, about recession fears, tariff fears. You have been in this industry, you've been a CEO. What is it like right now?
Well, right now it's uncertainty is as high as I can remember it since my entire career, which goes back a long way to the 60s.
But that's a long, long way. So you've lived through a lot. What would make it more certain? What is the biggest uncertainty?
Well, I think people are playing with multiple uncertainties in different jurisdictions in the world. You know, but the underlying one is, you know, does this impact the world, and would it change overall growth? Could the growth stop in the world? I personally think it's unlikely, but who knows? So I think people want to see some certainty, and of course that's very tough to get as each of these things change. You know, everyone's being affected at the moment by uncertainty in demand, affecting oil prices, markets. So people want to wait and see.
Is the wait and see going to then become a continued search for Beyond Net Zero, an energy transition, decarbonization? Is that still something that the energy community is committed to?
Well, we think it is. Obviously, we'll be as pragmatic as anybody, but we've found over the last few years, by investing in things that improve efficiency and effectiveness, we can invest for all seasons. We don't have to worry about whether a government's supporting something or not supporting it, whether giving us tax breaks or not tax breaks. We just look at things that are commercial and have pretty good returns. And they're in efficiency, as I said, and actually in things like the circular economy. Doing more with what we've already used and redoing it is great for efficiency and effectiveness, but all these things are great for the environment because they reduce carbon dioxide output.
Is that a different message than a couple years ago, where it would be like we need to reduce carbon emissions because it's good for the environment?
Well, we also believe that, but we've also been...
Two things can be true.
They can, or they are. I mean, it's a virtual coincidence. But, you know, we're an investor not in heavy assets. We're asset light, so we look at the way software, and today there's what a choice we have of that with generative AI, how it can make things better for the world, and thereby reduce greenhouse gas emissions, thereby reduce the worst impacts of climate change. And we'd like to do our bit in that. We're not big enough to affect the whole world. What can you do with $3.5 billion? You can't do as much as you can with $3.5 trillion.
This is very true. Are there certain new energies or alternative energies right now where the value is really good?
Yes. They're energies, so wind and solar and batteries have come a long way. And they're now actually really cost competitive sources of energy. Cost competitive for people who want to diversify, cost competitive for people who don't have energy in their nation. You know, these are really important things for the future. So this is not about subsidies. It's about economics.
The other side would say, or a counter argument would be, oh, well, it's intermittent, and we need the base loads of nuclear or natural gas or coal to supplement. How do you guys view it?
You need all of the above. You know, wind and solar with batteries can produce effective base load supply, depending on where you are. One size, I'm afraid, doesn't fit all. And, you know, you can make lots of sweeping statements, but it all depends on the details. But actually, you know, even in the US, you know, the wind and sun are out of sync between, you know, Arizona and New Mexico. So, you know, if you add the two together, you could produce great semi-baseload supplies for California.
So it's been a tough lesson for the energy shift transition over the last few years with the war in Ukraine, along with now President Trump policies, the inflation that we got as well. Are you getting any indication that on the margin, abandoned oil and gas areas or areas that were too risky or something might become viable again?
So first of all, no one abandoned oil and gas or coal. I mean, coal demand has been kind of flat for the last 10 years, so people forget that. And oil has been rising roughly at 1 million barrels a day a year for a long time, and gas at 100 billion cubic meters a year. They're rules of thumb, and they carry on. So we've had a lot of supply, and oil and gas will remain part of the energy mix for a very, very long time, because there's nothing to substitute them. So some things will open up, but opening up is about the price of energy, and it has to be competitive pricing, and it has to be about your sense of the risk you're prepared to take. In the case of oil, you have to be sure that whatever price you think you're going to produce at is going to survive for 20, 30 years. And so that's always a big consideration.
Yeah, and the curve has been changing quite rapidly.
Curve changes daily.
Yeah, there was a report from the UK government that they unveiled proposals that could ease the tax burden on offshore oil and gas. They'd still ban any new leases, but they could ease that tax burden. Is that a signal? Like, what does that tell us? I thought the UK was going to be like all wind.
No, it can't be all wind, and it can't be all solar. I wish it could be all solar.
Definitely not solar.
But,
it's the UK.
Well, no, actually, as time goes by, the solar's better, even in cloudy conditions.
Okay, fair enough.
So it's got to be a mix. The key thing is diversification. You know, diversification, if one thing goes wrong, you've got another thing. If geopolitics gets in the way, you can't get electricity from a connector or gas from imports. You need diversification. It's what Winston Churchill said. The only point of security, the only key of security is diversification. So making sure that what remains in the North Sea, which is not a lot, it's really it's had its way past its best, is used appropriately, is probably a good thing.
So regionally, when we talked about how you guys invest, right? Like asset light, really about the circular economy, where regionally is there the best opportunity for that?
So we've focused on really quite big chunks of the world. The United States, it's not by no means the majority of investments, Europe, Sub-Saharan Africa. So all of these areas have different things you can invest in, depending on the particular nature of the region. You know, is it long or short energy? What is its what does it really want to do? What's its ambition in life? And it changes over time. And so you've got to be pragmatic, you've got to work these different places to see what's really good for you.
Or it changed quickly, as in the United States. So what would be good investments right now in the U.S., where a lot of the uncertainty, you could argue, is originating from?
Well, what's changed, of course, is the way in which the federal government is looking at these investments. And that one should expect. I mean, governments change. You know, governments tend to, I always like to think that what governments do for the energy business is kind of temporary. And they come and they go, and there are long cycles of change. It doesn't change what has to be done over the long term. Obviously, if you've got public market investors, you've got to worry about them quarter by quarter. We're in the private markets, we can take a longer term view. But long term, it's clear, the world needs more energy. It moves 50 million people out of poverty every year by getting access to energy. It's good for the climate if it's done in the right way. And remember, making sure we are not subject to climate change is not about saving the planet. It's about saving humanity from being ravaged by what's going on around them.
A different voice than what we normally hear at CERAWeek. I really appreciate it, John. Thank you very much. Lord John Brown, of course, he's chairman of Beyond Net Zero. Guys, I'll send it back to you.
All right. Thanks so much, Alex. Do appreciate it. Once again, Alex Steele out there at CERAWeek in Houston. Lord John Brown, the former CEO of BP. For more of our CERAWeek coverage, check out our live blog on the Bloomberg Terminal and for day 2 tomorrow as well.
All right, some stories crossing after the closing bell. Let's toss things over to Charlie Pellet for an update on that. Charlie.
I thank you very much. And here's what's going on. We are keeping an eye on Delta Airlines shares after hours because right now the stock is plunging 15%. Delta has cut its profit expectations roughly in half for the first quarter as demand for air travel softens. Now, this is not a Delta exclusive story. We've got United down after hours, plunging by 11% after hours. American down by 4%. But again, Delta cutting its profit expectations roughly in half. That is the headline right now from the Bloomberg Professional Service. Also after hours, keeping an eye on Oracle. The stock right now little changed, up by about 0.5%. Oracle reported a surge in bookings and gave a revenue forecast for the fiscal year beginning in June that did top estimates. A down day today for the Dow, the S&P, and NASDAQ, and that is putting it mildly. In terms of percentages, a 2.7% plunge for the S&P, ending the Monday session at 56.14. The selling continues. The S&P today down 155. The Dow down 890, down 2.1%. NASDAQ Composite Index plunged 4% today, and the NASDAQ 100 Index down by 3.8%. Cannot ignore Tesla. That stock today down 15.4%. 10-year 4.21%. The 2-year 3.88%. Gold down $20 the ounce, down 0.7%. West Texas Intermediate crude, just talking about the oil industry. WTI 65.95 a barrel, down 1.7%. And Bitcoin now with a $78,000 handle, 78,700 on Bitcoin, down 5.2%. Again, recapping, stocks lower, S&P down 2.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Airlines certainly one to watch tomorrow, Carol Master.
Yeah.
Global markets, though, experiencing volatility due to anxiety over tariffs and government firings. American stocks being heavily impacted in demand for recessions havens are boosting sovereign bonds. The S&P 500 extended its plunge. The NASDAQ 100 saw its worst drop since 2022. Treasury yields sliding on bets that an economic slowdown will force the Fed to slash interest rates. We've got someone here with a great global view. It's great to have back with us Michael Lowen. He's CEO of IDA Ireland. It's the foreign direct investment agency of the Irish government. Michael joins us here in the Bloomberg Interactive Brokers studio. Welcome back. How are you?
Good afternoon, Tim. I'm great, thank you. And to Cara, great to see you.
It's good to see you. Listen, we got to just start with tariffs because that's exactly where things are with the U.S. right now and with what historically have been some of its closest allies. How are you looking at this regime in terms of international trade?
Yeah, so I think from an Ireland perspective and a European perspective, obviously, our position on tariffs has been, I suppose, consistent, and maybe that's one thing you mightn't just associate with today's environment. Consistent in the context is going to be disruptive. I think it's going to be negative on the global economy. It's obviously, as we can see, it's leading to uncertainty, and uncertainty leads to lack of decisions and lack of investment. And we're very conscious of that from an Ireland perspective. And what we have to think about is, okay, from us as a small open economy, which we are within the European Union, how do we make sure that the stability, the proven track record, the trusted relationship that we've built over many decades, how do we ensure that actually comes to the fore? Because I fundamentally believe that for economics to continue to prosper, for companies to continue to invest internationally, they need locations like Ireland. They need to be able to go into locations that are proven, that are trusted, and are strong partners. And that's effectively what we're going to continue to focus on, notwithstanding there are headwinds in front of us.
There are headwinds, and then there are headwinds. So, Michael, are you concerned about U.S. policies by the Trump administration impeding more foreign direct investment into your country?
So I think I probably have mentioned over the last 2 years, we've seen a significant change in the competition for foreign direct investment. So that journey already started probably 12, 18, 24 months ago.
But even so, you have a lot of big tech giants that still have very impressive setups over there.
We do. We have a lot of big tech companies. We have a lot of big life sciences companies. A lot of big financial services and fintech companies. And the reason we have them is because we bring value, and those companies get value within Ireland. And maybe just to give you an example of that, if we look at the total output that comes from our FDI base in Ireland, it's over about 420 billion on an annual basis. 85% of that revenue is outside of North America. It goes to international markets. So Ireland is a real hub for international access, whether it's into Europe or across the rest of the world. And that has a flow back and benefit to those companies and investors in Ireland as well. So,
sounds
so
like
like
you're getting ready to go to Washington and make these arguments.
Yeah, well, certainly this is the week that we, from an Irish perspective, we're working our St. Patrick's Week. We're making sure that all of those key points in terms of that partnership with Ireland is clearly understood. And remember, it's a two-way bilateral relationship. Ireland is now the sixth largest investor in the United States of America as well. So it's an incredible two-way flow, and that's come from being open and a trusted, proven partner.
Well, I'm wondering, though, about this idea that the United States in the last couple of weeks has really shifted its position with allies and close partners, Canada and Mexico, for example. And the president has had words for the entire continent of Europe and the European Union as a result of what he sees as not sufficient spending on the continent's defense. Does it feel like the U.S. is as close of a trading partner and as close of a partner as it's ever been right now?
So I think what we've seen over the last number of weeks, and in particular, we've seen a significant change in that engagement. There is no doubt. You've also seen the response from Europe, and maybe a realization that Europe has to do more on defence, for example, which you've commented on, Tim. And I think all European countries, and particularly there was a summit last week and the week before, are committing to further engagement and spending in terms of security. And I think that has to be welcome because, we've over the last 24, 36 months, we've seen a very big change in the landscape in Europe. I think the war in Ukraine certainly was a very significant change in Europe, and that has changed perspective, and I think you've seen that response as well. But I do hope that if you think about the Europe and the US, it's the largest trading bloc in the world. There is 6 billion of daily trade between US and Europe. And I think protecting that, and if we look at what that looks like at the moment, the trade deficit is less than 3% between the two blocks. It's quite small in overall scheme. So you have to think about building on that, because I think there's more to be gained in terms of collaboration and working together as two significant blocks than there is apart.
Are you, though, nervous? I am curious if you folks are nervous, though, about the relationship between the U.S. and Ireland changing significantly. Based on what you've heard out of the White House so far.
Yeah, of course we have to, we're very conscious that there is a change in terms of policy, but we're also very conscious that there's a deep, I suppose, relationship between the US and Ireland. It dates back, like last year we celebrated 100 years. The US was one of the first countries in the globe to recognize Ireland as an independent state. So it goes past, let's call it 6 months, 8 months, it goes back 100 years.
Right.
We would hope that stands, to the future. We look to it in terms of a close partnership with the US, and we look to bring value to the US. And as I say, it is a bilateral arrangement. We are a strong investor in the US economy, and the US is very important to the Irish economy, and we certainly would like to see that continuing.
Is there concern that we won't see that continue?
I think at this juncture you have to say that we're conscious that there is a change in direction, but we're also very confident in terms of what we offer and that bilateral arrangement.
But how, given the change that we've seen over the last few weeks, what have you had to do differently? What will Ireland have to do differently in order to make sure that it appeases the U.S. government?
Yeah, I think what we have to do actually, some of the things we have to do we've always done, which is be that proven location, a trusted partner. We would see ourselves as a very trusted partner with the US and indeed with our European partners. We have to continue to be that trusted partner and that safe location and proven location. That's what we're going to focus on what's inside our control, because we cannot control what's outside of that.
Michael, just got 30 seconds left here. Are you surprised to it sounds like everybody's not quite sure what their relationships will be going forward. Are you surprised to be kind of at this point when it comes to a relationship that Ireland has had with the United States, as you said, for a century?
Yeah, well, I think this week, Carol, reflects that relationship as well. You know, we are having, you know, an entire week, in fact, an entire month has been designated now to recognise the heritage with Ireland. I think that's a very strong signal of the respect that exists between both nations. And I think we're very thankful for that as well and appreciative of that. And this week actually is a real opportunity for us to ensure to build those relationships, because it's like every partnership. Every partnership has to be worked on. And I think this is no different. And we're certainly in that I suppose, that focus this week is about ensuring that we put Ireland's best foot forward.
Well, we hope we can hear more from you too on the other side of your time here in the U.S. Good to always see you. Michael Lowen, thank you. He's CEO of IDA Ireland, the foreign direct investment agency of the Irish government.
Well, today is a great day to kick off a new feature on our program that focuses on 3 stocks. So let's take a look at some stocks that are on the move today. Bailey Lipschultz is a Bloomberg News equities reporter. He joins us here in the Bloomberg Interactive Brokers studio. Bailey, you had plenty to choose from today.
A lot of red, too. And starting with the worst performer in the S&P 500, that is none other than Elon Musk's Tesla, down 15%, guys. Worst day since September 2020. This coming as analysts continue to cut expectations for sales, but also as investors really rotate out of a lot of those big winners. We had seen Tesla really riding the wave of momentum after Donald Trump won in November, and then really pulling back and erasing those gains. And now, again, worst day since 2020, closing at the lowest level since October. A lot of money lost.
I want to talk travel stocks, but I also want to expand our day, which is, normal market times from 9:30 to 4, but we also got some news after the closing bell.
Until the NASDAQ goes 24/7.
Yeah. That's true, until the NASDAQ. But we did get some news from Delta after the market closed, and you've got Delta Airlines down 12%.
Wow. Delta Airlines down 12%, and that's leading to other airlines trading lower, as well as cruise stocks. That coming after Delta slashed their profit forecast, citing weak domestic travel demand. The interesting thing from that earnings report and snapshot that we've seen so far, premium flyer, totally fine. It's everyone else who's really struggling, and that's impacting the business. So if you're well off and can fly first class for a few $1,000s,
I believe they call it Delta One. At the front of the plane.
I haven't, when I sit in the back,
That's what I heard, Bailey. That's what I heard. You also mentioned cruise stocks. Are we seeing them hit after hours too as a result of domestic spend perhaps being pulled back on discretionary purchases?
We are. So Carnival Cruise, or Carnival Corp CCL is the ticker. That's down about 3%. Norwegian Cruise Line, which caters to a more affluent consumer in Europe, down 1.8% also. So we're seeing investors pulling away from kind of these really discretionary companies. We saw Carnival down more than 7.5% today's session. Biggest drop since June 2023. No news there. Just simply investors rotating away, just given the uncertain economy, especially when you look at companies that their profit is really driven by U.S. consumers and people wanting to spend on more luxurious vacations, not necessarily the travel you need. And also just keep in mind, though, we had seen a pretty robust tear for Carnival and a number of those companies over the last 12 to 18 months.
I mean, consumer discretionary as a whole down almost 4% today. So no surprise, one of your worst performing major industry groups in the S&P 500. However, it was really good to be Redfin today. Certainly, and if you were an investor in Redfin and bullish on Redfin, you were pretty happy.
Yeah, the stock closing up 68%, which sounds great until you think about it and go, okay, well, it's only closing at the highest level since December. It's been a rough go for the company. Going to be acquired by Rocket for $1.75 billion. It is an all-stock deal, so we did see Rocket shares under some pretty notable selling pressure this morning. So investors, whether it's arbitrage, traders trying to game that out. But the interesting thing to me, an interesting thing from a number of these analyst notes, is people use Redfin or Zillow to buy houses. Right. Well, Rocket offers you the mortgage. So if Rocket can get this deal approved by regulators, then you kind of have a one-stop shop for home buyers.
It's interesting though. You mentioned the rocket that was down what 15% on the news today.
Yeah.
Is it oftentimes we do see the company that's acquiring the other company move lower? Was it exacerbated by the sell-off today? Is it investors saying we think you're overpaying? Is it the idea that we don't necessarily think this is a great buy for you? Is there a signal that we can look into?
It didn't seem that way. The one thing to keep in mind, though, is when you do have M&A, to your point, that kind of merger arbitrage creeps in, but especially that's pronounced when it's an all-stock deal. So you actually can actively short Rocket and buy Redfin, knowing you will get shares on the back end, as opposed to a cash deal where you're kind of positioning with a bit more of kind of an alpha flavor.
Yeah, great point, Rob. All-stock deal, $12.50 a share for a Rocket to buy Redfin.
Hey, since we're talking stocks and we're talking about what's moving, I mean, we did see Oracle come out with their earnings, and while initially the stock bounced around in the aftermarket, ultimately we saw the stock rally. I think some upbeat expectations about the outlook here, but it's just a reminder, Bailey, too, that yeah, stocks in a day where we saw a lot of selling, you still see companies and specific stocks trade on fundamentals.
Yeah, and there is a reaction, as you mentioned, strong bookings number, obviously a lot of optimism around what Stargate could mean. But again, closing at the lowest level since early September, so you're at a 6-month low. Investors maybe, again, it's going to be interesting to just keep an eye on what Tuesday brings, because when we do see these big sell-offs, turnaround Tuesday, maybe, fingers crossed if you're a bull.
I mean, on Friday, it was like the S&P 500 was back at levels, from before the election, now back at levels since September. So at one point today, Bailey. So we're sort of this round trip pre-Trump election.
Yeah, and it's getting interesting. It's getting to the point where everyone throws out the word capitulation. It's been coming up more in conversations.
We're not even
today.
9% off of all-time highs. Are we talking about capitulation?
That it wasn't really today.
No.
You didn't see just everything falling off a cliff. You kept pointing out stocks hitting 52-week highs.
52-week highs in the S&P 500.
Exactly.
No, and to your point, Tim, it's kind of like we had this insane rally after the election, and now that money's rotated.
Like a little perspective, people. A little perspective, people. But we will see certainly what tomorrow will bring. Right now, though, I'm looking at those airline companies, and they are just really getting beaten up. Delta down almost 14%. American Airlines down about 7%. United down about 11%. This is Delta came out and cut its profit expectations roughly in half for the first quarter, citing economic uncertainty that is hurting demand for domestic air travel. Bailey Lipschultz, thank you so much. Bloomberg News equities reporter. That's going to do it for us. Monday over. Good stuff. I'm Carol Master, Tim Stanovic. Balance of Power starts now.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Kaylee Lyons, I'm Joe Matthew.
Stocks extend a brutal sell-off driven by anxiety over tariffs and growth, as President Trump says the economy faces a period of transition and